Good morning, everyone. It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance Live. Here is what we're watching this morning. The markets are all in on everything rally. Tech, bonds, Bitcoin, all having a big month on rate cut optimism. But how long can the upward trend and momentum carry? We look ahead to the next stage for the melt up.
Plus, Tesla's long-awaited Cybertruck is here. CEO Elon Musk delivering the first pickups to a handful of customers yesterday. Now, yes, there's lots of excitement around this new truck, but will its higher than expected price tag put a dent in demand?
That's right, and preparing for proxy battle. Disney reinforcing its board with 2 new appointments and restoring its dividend after a 3-year suspension. CEO Bob Iger readying as activist investor Nelson Peltz jockeys to gain more control at the company.
Well, November certainly was a strong month for stocks. Now, the market rallied during the month with all 3 of the major averages recording their biggest monthly gains of the year. Now, tech stocks were back in favor once again, a trade that has really helped the Nasdaq and, of course, the S&P 500's performance since January 1st. Most of it focused around the Magnificent 7 stocks. So how does this set us up for the last month of the year? And then, of course, into 2024? Well, historically speaking, December tends to be a pretty strong month for investors. But looking ahead to 2024, there certainly are a number of potential risks out there. We talk about the presidential election that's coming up and also tensions overseas, what exactly the pressure that could potentially here put on the markets. But Brad, I want to start with a lot of this optimism that we have certainly seen play out. We're going to talk a little bit about the FOMO rally here in just a minute, but focusing on some of the gains that we saw over the last month. You have the S&P, the Nasdaq, and the Dow all recording their strongest months that we have seen in just about a year. You talk about the Dow notching its highest close in just over a year right now, snapping that 3-month losing streak. So how does this set us up into 2024 and into the final month of the year? A lot of it's going to revolve around Fed speak, I think, just in terms of some of these short-term moves. We're going to get the jobs report next week. That's going to give us a glimpse into how resilient the labor market could have potentially been. There's lots of questions just about whether or not we will continue to see a strength there as the economy continues to weaken just a bit, or fears of it weakening just a bit, I should say. And then, of course, what exactly that means for 2024, what the gains could look like. We have seen from strategists across the board, the estimates for next year are pretty much all over the place, I think, to put it lightly.
They are. Yeah, they are indeed coming in all over the place. I guess that would put me in the Grinch camp here when I have to think about some of the things that keep me pessimistic about the markets right now. And there are a few things most notably. And I would actually start off with what you'd mentioned a moment ago, the Fed. The Fed could very clearly come out here, similar to Mary Daly yesterday, be the cold water and say, don't hold your breath for a rate cut. If that is the case, then these markets are certainly going to be kind of in wait and see mode for what the data and the data-dependent Fed is seeing in the inflationary picture to really march towards that 2% target. Now, that's a 2025 target here. So as we get into 2014 as well, it's going to be amazingly incremental to track some of the employment figures as the backdrop, because that's what the Fed has been able to lean on to this point in time. I think you've also got what's brewing in terms of some of the CEOs out there, one of the biggest headwinds to their own 3-year growth projections, and it is geopolitical uncertainty. Many of them continuing to cite that quarter after quarter, at least as of the most recent 2 periods, marking periods that we've been able to grade some of the performances, the financial performances on. And so as that lingers, you're going to hear more about cost discipline. And I would also add, you throw in an AI rug pull when you have some of these companies that are not going to be able to deliver on everything that they were talking about, from productivity to streamlining and synergies, and putting all of that on the back of AI. Some of the investors are going to wake up and see at the end of the day that artificial play, or at least the talking points that many companies, some of them that have to deal with food and beverage space, are not going to see the same type of flow-through beneficiary to their bottom line as a company like an NVIDIA, like a Microsoft at the end of the day. And so that, I think, is going to be one of the larger concerns that we also got to consider here, too, going forward here. I'm sorry. I'm going to take off my Grinch helmet.
There's a lot of pessimism
I want to be holiday
cheermeister. We're only 4 minutes into the show.
want to be happy here.
All right.
I just had to take the other side of the conversation here on the morning here. Well, investors' FOMO, the fear of missing out, appears to have taken over the recent November market rally as worries about high rates seem to be tapering away. Let's bring in Yahoo Finance's Josh Schaefer to dig into the biggest winners and what meme stocks are drawing attention. Meme stocks here this morning.
So meme stocks are back, Brad.
Wow.
You were being really negative, so I'm just going to show you a bunch of one-month charts to remind you we just had the best month in a year. How's that sound?
Let's do it.
Let's just
Please, we need
can
all
just
the
rip
help
through
we
some
can get at this
sectors
point.
that just had a great month, right?
Yes.
We just came off the best month in a year, and Brad wants to talk about how things are so bad.
Look, I'm in a great mood today. I wore my gray suit for this.
I put on my gray suit with a smile.
Me too.
But I was taking a look.
Okay.
So let's look at some of those stocks. I want to look at some of these stocks that were up huge in November and sort of why they were up so big. We're calling it the FOMO trade because basically at some point with the S&P 500 up almost 20% this year, at some point investors want to get in, right? And when they get in, they're going to try and get into some of these names that haven't necessarily rallied this year. And that's some of the sectors that we saw were the biggest winners in November. When you take a look at something like regional banks rising about 16% over the last month, you take a look at Cathie Wood's ARK Innovation Fund. That fund had not done too well this year, up about 10% going into November. It's up 50% on the year now. So some stocks right there that just really hadn't had a great run. You can see there the last 3-month chart. So that big tick up in November, quite a run for ARK there. And then Brad, you mentioned meme stocks, and it's been interesting to watch when we talk about meme stocks. Originally, it wasn't GameStop. We were talking about the Roundhill Meme ETF, which I believe is actually going to be closing. But a big part of that, like one of the holdings in there was Coinbase.
Yeah.
And Coinbase is what took off. We weren't talking GameStop, AMC necessarily. We were talking about the actual meme ETF itself, which normally is just more a barometer for investors wanting to be risk on, right? And sort of seeing, all right, we're not talking about how high we're going to go anymore, or if we're going to get more rate hikes. We're starting to talk about rate cuts when we get into some of this risk. And so that was sort of what we saw from the trade overall, though I should mention, just 2 days ago, I was writing that GameStop was up 20%.
Well, that's the thing about this market, right? It could be a daily sort of thing in terms of the narrative and what you are writing about specifically, because even over the last several weeks, you have had a number of pieces about a soft landing and maybe the fact that we're actually going to be able to navigate this and we could see higher highs as we look ahead to next year. There's been a handful of calls out saying that the S&P 500 is going to hit 5,000, going to hit 5,100 by the end of 2024. On the flip side, though, we also heard from JP Morgan raising some issues as to why we should maybe be a little bit more pessimistic going into the new year. When you take a look, I guess, from the strategists that you have been talking to, how on the fence do you think they are just in terms of this uncertainty out there and the fact that not something would necessarily break all of a sudden, but certainly we could change course in terms of the narrative of the market?
It's interesting because I think a year later, last year, everyone was worried, right? And everyone wanted to talk about some of the things that JP Morgan highlighted in that 2024 outlook when they called for, what was it, 4,200 or 4,500 on the S&P 500, and basically flat or lower, right? And they were sort of highlighting the recession risks, the fact that consumer might slow down. And I think the bulls now feel a little bit more comfortable in saying, well, we've been listening to that for a year. We've been listening for a year that the consumer is going to slow down, that certain parts of this market are really going to get hammered, and it hasn't fully happened. So I think people feel a little bit more confident in that and essentially saying, all right, the economic indicators have largely held up. Maybe they can hold up for another year and we can sort of avoid and skirt that recession. That's been one of my bigger takeaways thinking about how people feel about 24.
Maybe it's not me being pessimistic. Maybe it's just JP Morgan rubbing off on me this week.
You read
Maybe
too much of
that's
that
what it
note,
is.
Brad.
That's the a la mode right now.
Blame it on somebody else.
It's their fault.
Yeah. All right. Well, we'll settle
gotta
with
be
that at least
someone's
for now.
fault.
Come on.
All right, Josh. Thanks so much. Let's continue to talk about the recent market performance and what we could expect looking ahead to next year, because a new month and a new outlook, while more strategists rolling out their 2024 forecasts, and Wall Street patiently looking to see what could drive the markets higher or potentially what could bring the momentum to the downside here. Now, Charles Schwab's Liz Ann Saunders believing that economic pain could potentially be likely in the year ahead, but that doesn't necessarily mean that stocks are going to struggle through the year, especially if there is a continuation of rolling recessions that have hit the economy. We want to bring in Liz Ann Saunders. She joins us now, Charles Schwab's chief investment strategist. Liz Ann, it's great to see you here. So let's talk about, just in terms of the most important factors or the driving factor for equities next year. What's on the top of your list in terms of what you're watching?
Well, I think clearly the move down in yields has been very important for the rally that started after the correction that ended in late October. So I do think that the bond market to some degree is in the driver's seat for the equity market. But obviously, I think the rally is also based on what is the current probability of rate cuts starting sometime in the first half of the year, maybe even the first quarter. I think that's a bit premature. We have to remember that probabilities around rate cuts have been a moving target for quite some time. We were back in March going through the mini banking crisis. It was expected that the Fed, as we talk now, would already have been in cutting mode, and that clearly was not the case. So I think the labor market is going to help provide clarity for the Fed. I also think that nearer term economic weakness, even a declared recession, oddly is probably the better scenario for the economy, for the Fed, for the equity market, than a recession that gets pushed further out, say into the latter part of 2024. So maybe a little pain might be necessary near term, but it's probably the better outcome.
I mean, that is welcome news to my ears this morning, Lizanne, because I think for a lot of people, they just have recession talk fatigue at this point, and we're kind of just sitting here waiting on the end of our chairs. When's it going to happen? We hear more calls this morning from Vanguard, mild recession perhaps next year. Raymond James, mild recession next year, and single-digit stock returns. So all of this considered, what would be the Fed's kind of purview that they would look to say, all right, we have enough data to ultimately say that we are in or are experiencing or about to experience a mild recession, and that we need to adjust course?
Yeah, and keep in mind that the official knowledge of a recession via a declaration and a start date given to us by the NBER always comes after the fact.
Right.
In fact, there are times where they've declared it, given us a start date, and it turns out once we found out the end date, at that point they declared it, we were already out of the recession. So I certainly wouldn't suggest sitting around waiting for that. I think what the Fed probably, the ingredients that are likely part of the recipe to not just stay in pause mode, which is justified, but actually pivot to rate cuts, wouldn't so much be a recession declaration. They know that's a lag in terms of the official nature of it. But to have both of their dual mandates sort of sending the right message. So inflation continuing to come down to, or at least closer to their target, in conjunction with more loosening in the labor market. They don't want to see a labor market that collapses, but they want to see a loosening. They want to see some more easing wage pressures. And I think once you have the combination of those two, then I think the Fed might start to telegraph easier policy. But probably the thought right now is stay in pause road and assess the so-called long and variable lags.
Lizanne, I think a lot of investors out there are trying to figure out exactly the best ways to play this market, given the uncertainty around the Fed, given the fact that we obviously don't know when exactly the rate cuts are going to start. We've seen some excitement when you take a look at some of those beaten down names like the Russell 2000, the small caps over the last several weeks. Are you seeing some tailwind there as we look ahead to 2024? And where else are you seeing those best opportunities?
It is interesting because over the past month, the Russell 2000 is actually outperforming the S&P 500. And I think that is indicative of some money that is looking to move into areas other than just the Magnificent Seven in the interest of seeing a broadening out. However, within that, I think you want to fade, to use trader lingo, the lower quality names that have done well, but continue to lean in up the quality spectrum. And one thing that's interesting about the Russell 2000 as an index, it's the most common small cap benchmark that's used. But there's also the S&P 600 as an index. And the only reason why I mention those two is that Russell doesn't use a profitability filter. There's close to 40% of stocks in that index that are not profitable. 31% of stocks in that index are zombie companies versus the S&P 600 that has a profitability filter. And as a result, it's trading at a multiple about, 8 or 9 points lower than the Russell 2000. So I'm not recommending the index, but if you're looking for an index as a source for ideas, inherently you have a higher quality index with the S&P 600 because of that profitability filter.
Lizanne, just lastly, while we have you here, we're in the holiday spirit. I mean, we're getting close to the end of the year. We're trying to put together some New Year's resolutions. Mine is to just say serenity now, just a little bit less next year. And for that, I need a top idea. What is your top idea kind of getting into 2024?
Discipline. I think this is the time for discipline, risk management, and it's about diversification and rebalancing. That's the best way to navigate through an uncertain environment.
Lizanne Saunders, Charles Schwab, Chief Investment Strategist. Great to have you here this morning. We appreciate the time.
Thank you.
Thanks. Well, let's get on over to Tesla shares. Taking a look at ticker symbol TSLA. The shares are dipping this morning following the company's big Cybertruck event in Austin, Texas on Thursday afternoon. They showed the truck performing some stunts and even beating a 2023 Porsche 911 in a race. But where some may be hung up is the pricing. The entry-level all-wheel drive Cybertruck, it came in at about $61,000. That's more than it had specified the company had back in 2019, where they were shooting for this ballpark of about $40,000 here. A ton of things to really think about with this, and our viewers are taking a look at the Cybertruck prices. There are going to be different modes. Cyber Beast, that top mode that you're looking at there, and then the all-wheel drive, which interestingly, that's the one that has the best mileage range on it here. But at the end of the day, I think the pricing really caught a lot of people by surprise, considering that this wasn't necessarily going to be looked at, or at least it was tried to be given the appeal early on when they announced it in 2019 of what could potentially be mirroring perhaps an F-Series type purchase on the lower end, or at least mass market appeal for a truck in that same price range. This is not that. This is a luxury vehicle type of annexation that they've just slapped on this with that type of price tag in an environment that's already harder to finance some of these vehicles. And then additionally, you add on the fact that a lot of the hang up and concern around people who are purchasing EVs continues to be the charging network, at least at this point in time. So as long as all of those things are answered for, and you do have people, the million of $100 deposits that were already put down, that then spend in and pay $250 now to just move forward with that delivery, just because there were only a handful that were actually able to drive off with their Cybertruck, then you could potentially see, all right, what the type of dent that this car is going to be able to put in the broader truck vehicle landscape going forward.
Yeah, exactly. And I think that is the big question right now, just in terms of what exactly demand is going to look like. We had the prices up on the screen, and those were after the rebate. So when we talk about the fact that a lot of these pricing in terms of what we're seeing today versus what we had expected when Elon Musk first announced this Cybertruck, it costs about 50% more than what he was saying back in 2019. Yes, obviously, inflation, it costs a lot more to make a vehicle today than it did back in 2019, but not 50% more. So I think the pricing obviously coming in at the high end was a bit of a surprise to many analysts. We're seeing that reflected in the quick reaction notes here this morning. And I think because of that, the fact that pricing is so much higher right now, analysts are having a bit of a tougher time just trying to gauge what demand is actually going to look like. We talked about the fact that many people put down money, not a lot, what was it, $100 deposit for these Cybertrucks, about 1 million of them. That is what Elon Musk has said in the past. But Tom Narayan of RBC, a friend of his show who's been on with us a number of times in the past, is saying that he believes that the conversion rate on the over 1 million reservations is going to be at the low end, likely under 20%. So when you take that into account, how big of a driver this is really going to be then for Tesla, probably not so much in 2024. You mentioned the fact that that baseline Cybertruck isn't going to be available until 2025. It won't really have a bigger impact, or an impact, I should say, until probably 2025. That's the consensus, I think, from the street here this morning. But I think it's still too early to tell, just in terms of the impact that it's going to have on the bottom line and exactly what it means for Tesla in the long run.
You know, you guys have been saying I've been pessimistic all morning. So here's the sliver of optimism I'm going to give this. Remember back when GMC rolled out the Hummer to the mass market and said, we're going to make this available. It came at a hefty price tag as well. But weren't you surprised to see how many Hummers were rolling around on the road, this massive just wagon of an automobile that would be coming at you down the highway, hopefully not oncoming traffic, but at the end of the day, you would see them and just say, man, who is buying all of these things? I think similarly, as much as this thing is an eyesore when you look at it on face value and even through some of the flashy, sexy B-roll that we have rolling right now, I think there are still people that are out there that are going to say, you know what? I will finance this. I will figure out a way to pay this off over time. I don't know that they're going to pay for that cyber beast model, which actually gets up into the echelon of the GMC Hummer EV that our own executive editor Brian Sazzi was just talking with CEO over at GM Mary Barra about that vehicle and what they believe it could be to the market. But if we see that same type of fanfare or reaction, at least, to just the shock, the awe, and kind of just being aghast at what this could be for the future of automobiles, that's the sliver of optimism that I would give this, is that you could see some type of similar reaction or reception.
I like that. Back on the positivity train.
I'm trying.
All right, let's talk about another big headline that we're watching, and that is Apple and Paramount have reportedly been in discussions about a potential bundling here for their streaming services. This is according to a report from the Wall Street Journal. Now, the potential combination of Paramount Plus and Apple TV Plus could cost less than the separate services here. And we know that they are potentially doing this, trying to have a more affordable offering coming at a time when many of the streamers, Apple and Paramount Plus included, have raised their prices most recently. Right now, the average cost of an ad-free streaming service has gone up by nearly 25% over the past year. You talk about the fact that many people who are out there who subscribe to these streaming services, they're not just subscribing to one, they have multiple streaming services. I am guilty of this. And they're taking a look at the bill, at their monthly bill, and saying, hey, we're paying way too much for some of these streaming services on a monthly basis. I think that this could be a very smart move here for Apple and for Paramount Plus, both trying to boost their numbers. These are two streaming services that have struggled a bit with churn. Their churn averaged about more than 7% in October, which is higher than what we saw across the industry, which is usually around 5.7%. Of course, though, Brad, one of the takeaways from this report is, could this eventually lead to maybe a potential M&A deal, a takeover here from Apple of Paramount? We'll see.
Yeah. Did you run the numbers on like how much all in you're paying on your services too?
No, it's too depressing, but I should do that.
I
That should be a budget, New Year's resolution.
I mean, I think a lot of households are probably going through that exercise right now, looking at all of the places where you've got money that's going out the door that you forgot about in some of these subscriptions too, and trying to figure out where you need to actually pull back on that, especially even across our entertainment services and platforms that we pay for. There is more of kind of stringent look on the discretionary purchases, even if they may make you laugh, make you chuckle, make you cry at some points in the day or night. Hopefully a confluence of all of them and not over-indexed on one. All that considered, we've continued to see year after year in some of the Deloitte Digital Media Trend surveys as well, where consumers are kind of fluctuating at this point between 2 to 3, and previously it was 3 to 4, the number of streaming services that they're willing to hold on to. This move between Apple and Paramount, to me, though, says it's all about some of those motion pictures. Apple is not going to be able to pay the same way to produce a high-quality motion picture, the way that Paramount has really already baked that in to the way that they operate in their own production house and the number of actors and titles that they've got licenses for. It's going to be interesting, especially on some of the license front that they've been able to take on. I think they have a license for Magic the Gathering, where that's going to be going into production for all the Hasbro fans out there. And so that is a big title that I'm not going to say it's going to be as successful as Lucasfilm or successful as some of the other titles that Disney has their own licensing over, but I think for Apple and Paramount specifically, this is kind of a meeting of the minds, recognition of where there could be overlap or synergies in some of their platform efforts and creating their own type of bundle where there is perhaps a little bit of a gap in both sides there. Also here, we're watching Bitcoin today, passing $38,000 in that mark, psychological level as it may be. We will see. Investors are keeping, though, eyeing a continued rally to push the asset over 40,000. That's definitely a psychological level. We've got our own Jared Blickery tracking its moves this morning. Jared, good to see you. What's the potential here for more growth for crypto, especially with those potential ETFs in focus?
Well, I think the potential here is that we're all going to be potentially wearing our Dow, Bitcoin 40,000 hats. Dust those off. We had those on a few years ago, got all the way up to about 68, 69,000. But I want to focus on what's happened over the last month, then we can get to what's happening in December. Bitcoin up 8%, Ethereum up 12.5%. Let me show you, because we had this monster rally in risk over the last 30 days. ARK was actually up 31%, meme stocks, that ETF 20%, Bitcoin all the way down here, 8%. So not even breaking a sweat, I would say. And let's get back to some of the charts. Bitcoin is interesting right here, and then I'm going to show you what's really interesting in Ethereum. So here's Bitcoin. We got that big, potentially God candle-like status that some people are saying, are attributing to it, and then we have this flag that is actually pointing upwards. Usually, when you have a little bit of a consolidation, it points downward, but this is there's a lot of buying pressure here. And let's take a look at Ethereum. This is at an important high here. We had this high over in April, and now we are flagging and looking like we want to push above that. Given the consolidation, this could easily hit 2,500. That's Ethereum pretty quickly. And let's take a look at what has happened in crypto stocks over the last month. Coinbase, you can see that's up about 61%. Block up 57% with admittedly a little bit less crypto exposure, backed up 50%, and the list goes on. Marathon Digital, that's another one investors track, that's up about 35%. But just thinking about the leaders this year, I said that Bitcoin is in the lower end of the pack, but when you look at the year-to-date totals, guess what? Bitcoin up 130%, New York FANG, which is a good proxy for the Magnificent Seven, that's up 85%, and then you go down the list. So really interesting to think that at the beginning of this year, with FTX in the rearview mirror and all the chaos, who would have thought that Bitcoin would have been the leading asset class?
Not I, but you know, you can never really count out Bitcoin, and you never really know how the heck it's going to trade or why it's trading the way it is. So we will see whether or not this momentum continues. All right, Jared, thanks so much. We'll keep right here on Yahoo Finance. We have all your market action ahead. Stay tuned.
Let's get into some market commentary of the day. One of the big debates among economists going into 2024 is the timing of Fed rate cuts. Deutsche Bank projecting a mild recession that will lead to 175 basis points in cuts starting the first half of 2024. Pretty aggressive compared to the market, which, according to the bank, is now pricing about 100 basis points of cuts. Here to break down all of this and the outlook is our very own Madison Mills. Maddie, what do we know so far here?
Yes, I want to look at a couple of the different calls that we're getting from the big banks on what we're seeing when it comes to rate cuts and when we're going to start seeing those cuts. That's the, of course, big question here. Sticking with what you mentioned, Deutsche Bank, Brad, projecting a total of 175 basis points of cuts starting in June. Now, interestingly, they did look at something called the Taylor rule, which I'm not going to get into the specifics of, but basically an economic theory that would indicate that the economy is slowing down a little bit faster than the Fed wants it to, given softening in the labor market and continued decreases in inflation. Deutsche Bank says that if that rule indicates that we are heading toward a recession, we could see the Fed start to cut as early as H1 of next year. And if you look at that chart, you can see the difference in Deutsche Bank's projections for the economy versus what we're seeing on the street now. But interestingly, Deutsche Bank's commentary not as optimistic as Bank of America, saying that we could see upwards of 50 basis points of cuts at that first meeting there. And they're also predicting cuts across the entire globe, not just here in the United States, and continuing calls across the street for more rate cuts heading into the new year, particularly following Waller's comments yesterday, guys. I'm really curious to see how Powell kind of potentially walks that back heading into the 11 a.m.
Yeah, Maddie, it's going to be very interesting to hear the tone and the rhetoric that we're going to get from Powell today, because like you just mentioned, we have had a number of policy officials in terms of be a little bit more optimistic that the Fed is actually progressing in its fight to tame inflation finally, that there are some reasons to be a bit optimistic that policy right now is restrictive enough in order for the Fed to eventually get inflation back to that 2%. I'm curious also how economists are going to kind of balance this, right? Because we talk about so much uncertainty, the fact that the landscape can really change extremely quickly, obviously, but so much of it is also going to be placed on the labor market and the strength and resilience and whether or not the job side of the equation is able to hold up and keep the economy on somewhat of a track.
Well, and that's why it's so interesting that the Fed commentary always fascinates me, because they spent so long talking about long and variable lags and that, we needed to wait a little longer to see the impact of their rate hikes. But we're starting to see this 2% number in the Supercore number with CPI there yesterday. So a lot of economists today wondering, are they potentially pushing us into that hard landing as well? Tim Dewey is an economist I follow who's great, and he talked about how if we're starting to see that 2% number already, and to your point, Shauna, if the labor market continues to cool and soften a little bit more, could we see that hard landing impact coming in if the Fed doesn't pivot quickly and get a little bit more dovish at the start of the new year as opposed to waiting until June?
Yeah, they're note titled Fed wins in 24, but at what cost? I guess we'll all find out.
That is what everyone's trying to figure out. All right, Maddie, stick with us here. We want to get over to the opening bell here and taking a look at some of the early trading action as we kick off the final month of the year, December 1st. You're looking at the Dow just below the flat line, the Nasdaq off about 0.3%. Jared Blickery standing by with a closer look at these early moves. Jared.
Shauna, only 2 minutes into the month of December, and we are looking at a couple of losses here. Nothing big. Nasdaq down about 0.3%. Russell 2000 down a little bit more, 0.5%. Just talking about small caps coming back a little bit with Liz Ann Saunders a few minutes ago. Here's the sector action. Only materials and industrials in the green. Looks like Staples trying to flip there, but not a lot of movement to the upside or even to the downside. Energy is the worst off. It's only down about 0.5%, and XLK, that's technology, is down just a little bit less than that. And here's the NASDAQ 100. See a red, but not dark red. So we're only seeing some outsized losers here, maybe in Tesla, down 2.3%. But I'll just remind everybody, this is what happened over the last month. So don't get too down on the markets today. And let's take a look inside tech because software has been outperforming over chip stocks recently, but looks like another sea of red here. And let's check out the semiconductors. NVIDIA down 0.33%, ASML a little green there, but for the most part, it looks like tech taking it on the chin. Just taking a quick look at some of the fringier parts of the market that did really well over the last month. Looks like we're seeing some risk off to start the month of December here as well.
All right, Jared, thanks so much. We want to turn to one of our big movers of the morning, and that is Ulta. Shares are soaring here in early trading. You're looking at gains of just about 11% after the company topped third quarter sales expectations. The retailer also raised its guidance, saying that the holiday shopping season is, quote, off to a good start. Our next guest raised her price target on the stock following these results, lifting her 12-month target for Ulta to $572 a share. That was up from $540. We want to bring in Corrine Wolfmeyer, Piper Sandler's Vice President and Senior Research Analyst. We also have Madison Mills here with us. Corrine, it's great to see you here. So certainly the street very encouraged by the results that we got from Ulta. What's your perspective? Obviously, you have a bit more of a bullish take now with the raising of your price target.
Thanks for having me. So Ulta reported an awesome print last night. I do believe, investor sentiment has been getting a lot weaker on this name. And we've seen it get a lot more mixed. It's been a much more controversial name in the current macro. We've seen promos pick up. So the stock has really come under pressure. And what we needed from last night's results was an inline print, maybe a slight beat, a reiteration of the guidance, just to rebuild that confidence in the name. And Ulta delivered well beyond that. Results came in ahead of expectations. They raised the midpoint of the guidance range, and they really proved that they are executing extremely well in today's pressured macro environment.
What potentially could be the biggest headwind to that dynamic? Obviously, we're on this great news high following those earnings yesterday, but what would you say is the single biggest thing that could change that dynamic, especially as we do start to see consumer slowdown heading into the new year?
It really comes down to the health of the beauty consumer and the level of promotions that we're going to see throughout holiday. Right now, we are starting to see some signs of the consumer softening in beauty, very minor, but we are seeing some signs. We're seeing some more price sensitivity. Consumers are taking advantage more of promotions. So if that intensifies throughout holiday, we could see some downside, especially if Ulta really does have to pull much more on promotions. But I think they've been extremely prudent in laying out expectations. They tend to be pretty conservative. They tend to really thoughtfully factor in various macro pressures. They have been considering a heavy promotional environment than we've seen in prior years. That said, they are working on better optimizing their promotions to make them more efficient. We are also seeing them do extremely well in mass beauty. That gives them a little bit of a competitive edge versus other specialty beauty peers. So I think they're very well positioned, but we are definitely watching the health of the beauty consumer. And if that does take a turn for the worse, then we could see some downside.
Corrine, when we think about the different kind of departments, and we tend to generalize this little luxury of beauty sometimes, but even within there are some areas that have a higher replenishment rate than, say, fragrances. I mean, if I've got one good cologne, I'm unlikely to, be like our executive editor, Brian Sazi, and go back to Abercrombie & Fitch over and over again and get more fierce cologne. I think for where the most cyclical purchases are, if there is one area that Ulta can lean into and continues to show strength, what is that from your perspective?
It really is those recurring daily use type products. Where we're seeing pressure are those one-time luxury items. Think of hair tools, those really expensive hair appliances. Those are a luxury purchase, and you don't necessarily need it. But what you do need as a female going into the workforce every day or going to school, you need your moisturizer, you need your cleanser, you need your mascara, you need all of this stuff. And that's where we're really seeing Ulta succeed, is in these daily use type products. We saw this in our Black Friday checks. Consumers who were lining up at the checkout, they were holding a lot of those daily use type products versus those one-time luxury items. So I do think they're very well positioned there.
Corrine, one of the other big announcements coming out of Ulta here recently is the CFO succession plan, because we did get news recently that Scott Settersten would be retiring in April. They have named his replacement. It's going to be Paula Oreibo. I know that you have met her. You had some time. You spoke with her over the summer. What is your perspective just in terms of how she is going to shape the future of Ulta and whether or not you think she's the right person for this job?
So we got the opportunity to meet with her this summer, and we were extremely impressed. Obviously, we're really sad to see Scott go, and he's done amazing things for the company over the many, many years. But I do think Paula's a really awesome fit. She aligns well with his thinking, and she aligns well with the CEO's thinking. But I do think she's also going to be able to bring in a more unique, innovative perspective as well. So we're really excited to see what she's able to do. Again, sad to see Scott go, but we were impressed with our interactions with her, and it does seem like she really interacts very, very well with the CEO and the rest of the management team.
And I'm curious too, Shauna was so smart to bring up the future of the brand. When you think about the growth story of Ulta, so many beats quarter after quarter. They've got 1,400 stores. They're looking to get 1,700. That's pretty feasible for them to get to that. What's the next big growth story for them in your view? Is it international expansion?
International is definitely an opportunity. I don't think it's going to be in the near or intermediate term. If you recall, they previously, a couple of years ago, had plans to expand into Canada. That's been put on hold. It does seem like they're really leaning into their existing presence in the United States right now. They still have a lot of white space potential. They're growing. They should grow about 50 units per year going forward versus about 100 previously. So still some good opportunity, but also there's still a lot of opportunity for them to capture share within existing beauty consumers in the United States. We're seeing consumers shift away from department store spending. We're seeing consumers really lean into specialty beauty retail, and that's where Ulta can really succeed. So I think there's a lot of share capture potential still in the United States. And then longer term, absolutely. I think international is an amazing opportunity to look forward to, but I don't think that's a near or intermediate term thing for them.
All right, well, they don't have to go far to reach me. That's the good news here. I watch
Me
more
neither.
beauty tutorials than I care to admit these days. Corrine Wolfmeyer, who is the Piper Sandler Vice President and Senior Research Analyst, thanks so much for joining us here, as well as Yahoo Finance's own Maddie Mills.
Thank you.
Well, for the first time in 6 years, Morgan Stanley is downgrading the world's largest luxury group to equal weight. That's down from overweight. The analyst lowering LVMH's price target from about $936 to $860 and citing weak demand and industry-wide deterioration for the downgrade, but noted that he still sees shares rallying 12% over the next 12 months. This comes after LVMH saw slow growth in its Q3 earnings report back in October here. And there's been more of a reckoning, I would say, around some of the luxury names out here. It's not just LVMH and the Morgan Stanley analyst note that came out here looking at some of the downgrade on the luxury goods giant here. It's actually been a little bit more broad-based, and we got a couple other calls. LVMH also saw a downgrade recently within the past few days to neutral by UBS as well here. But I think the mood here, if you're checking the mood ring on some of the larger luxury houses here, especially within Europe, higher interest rates and inflation really pressuring some of the consumer wallets there, and that's really leading to some of these calls that we're seeing come through.
Yeah, it is. This is all about demand and demand deteriorating during this quarter, the very crucial holiday quarter here for retailers. And then when you look ahead, at least in this Morgan Stanley note, saying that 2024, the first part of it at least, could be a bit rocky, could be a bit volatile here for a lot of these luxury players. Now, when it comes to LVMH, and this is what Morgan Stanley pointed out here in their note, one of the greatest risks to LVMH in this broader macro slowdown that we've been talking about is their dependency on China. The fact that that recovery has been much slower than people had initially anticipated, it has really hurt the likes of LVMH. And that story, or that headwind, I should say, isn't going anywhere anytime soon. So that is expected to weigh on sales here looking ahead to 2024. You mentioned the fact that so many on the street have been a little bit more bearish. And I think you're spot on with that, because take a look at the commentary that we're getting from HSBC recently. UBS also downgraded LVMH, talking about the fact that they don't really see that outperformance or this catalyst anytime soon, because I mean, people don't have $2,000, $3,000, $4,000 extra bucks to spend on handbags, to spend on shoes that maybe they were buying during the pandemic. We certainly have seen a shift maybe in the luxury consumer, in the fraction that was pretty resilient up until this point. So the fact that we are seeing a bit of a pullback here is a bit of a cause for concern.
I mean, and that's why LVMH has really put together this very broad portfolio of some of those luxury goods, where if you did see perhaps a trade down or a trade off of some of those more expensive items, sure, that'd be a near-term headwind for them. But then where do you tap into some of the other elements of the business? Because look, at the end of the day, if people are going to have some sorrows, they might just drink those sorrows away. And Hennessy, that's a good counterbalance and a kind of weighted portfolio at the end of the day that LVMH might lean into here. Look, I'm just saying that some of the consumers out there might prefer that, but I mean, it's not my preference at the end of the day.
All right. What is your preference?
It is Friday. It is Friday. You know, I'm day by day. I'm day by day.
You're still all just about Foot Locker.
I am. I haven't got my
LVMH.
I haven't gotten my store visits in this week the same way that I'd like to, so I gotta get
Wow,
in
and
there.
it was a big week for the company, too.
was, yeah.
Slacking. All right, let's get to another mover today. And Citi downgrading Spotify from buy to neutral, but leaving the price target unchanged. You're looking at pressure off about 1.5% this morning. The analyst citing worries about the company's ability to raise its average revenue per user while also reducing the number of users who stop using the platform, also known as churn. Now the firm is saying that the risk reward on Spotify's strategy and execution is no longer compelling. A lot of this is because of this valuation call, that last line there. The risk reward setup no longer impressive right now, at least in the eyes of Citi. When it comes to some of the changes that Spotify has made here over the last several quarters, we talk about the fact that they had spent so much on their podcast business, investing in their podcast business, trying to build that up. We have certainly seen a turn or a shift in that strategy, pulling back just a bit. They've also announced some price hikes here, trying to do everything they can to boost their profitability. Yes, the last results were rather impressive when you talk about this return to profitability here, the first time that they have posted a profit in just about a year. But what it's going to take to continue that momentum, that's what Citi's bringing up with a number of these risks.
Yeah, that profit was up 18% year over year. In their most recent report that you were just mentioning a moment ago, that gross margin came in at about 26.4%. But can I say that I am jealous right now of all the little people that are coming out with their Spotify Wrapped? I don't have a Wrap. I have Apple Music. I mean, yeah, you get
Spotify?
I don't have Spotify, so I don't even know what my sound count is. I have no idea.
Well, that's reason alone to switch. Maybe you could help the subscriber numbers here.
I guess so. I mean, it was. I didn't even get a chance to talk about this new Andre 3000 album with the people out there. We'll do that for another day here. I've got a 6-point thesis on that. Maybe I'll just tweet it out. But at the end of the day, I think it's really on the back of some of the creativity that they're able to see, not only from artists, but also from podcasters here. Mm-hmm. Podcasts have been massive in the way that they're also being able to come up with different forms of getting that message out beyond just the podcast. Spotify, they were very smart to lean into that early. It's a lot of spending, though, that takes when you're trying to make sure that you've got the right personalities on that. For Apple, what they've been able to do well is just create the platform that people could then upload into. And so at the end of the day, I think for podcasting as the strategy, it's still going to come down and kind of be circular to how the strength of music catalogs move forward here. And that's where Andre 3000 really just kind of dropped the mic or dropped the flute moment here is what we saw.
We've talked a lot. The two of us about Andre 3000.
I've already given you my dissertation.
I know, and I've yet to listen to it, but maybe that's going to be my homework this weekend. All right, guys, we got to leave it there, but keep it right here on Yahoo Finance. We got more of your market action ahead. We'll be right back. Pfizer out with some weighty news here this morning. Now the company is going to stop developing its twice-daily version of its experimental weight loss pill. But could there be an upside to this? Does it look like the street thinks so, with the shares off just about almost 6%? We want to bring in Anjali Kemlani joining us now with more. And when you take a look at the street's reaction, they're certainly looking at this that it's a big setback here for Pfizer.
Yeah, absolutely, because the twice a daily is going to be the one with more, usage of the pill. But meanwhile, it's important to remember that Pfizer is moving forward with its once daily pill of the same one. That's danuglipron. And that drug is their obesity drug, their weight loss drug, which did have some negative sort of results, which is the reason why they stopped. More than 50% of participants dropped the drug based on feeling nauseous, vomiting, diarrhea. Sounds like an ad for Pepto-Bismol, but a bad one. And really, this does allow Pfizer to stay in the GLP-1 game, but maybe with a less effective one. If we look at the data from this, the mean weight that was lost in the first 32 weeks was somewhere between 8 and 13%. Meanwhile, the number did drop a little bit later on with the weeks, but it does still have some decent output, some decent data. We do have to wait for the readout for the once daily. That is said to be coming soon. So all eyes on that for right now to keep Pfizer in the game.
Anjali, well, we've got you here in the newsroom. You've also been covering news on the M&A front in the healthcare space. How are we kind of rounding out the year that has been 2023, and what does that set up for next year as well?
Yeah, so the big news is, everyone's got their eyes on this big mega merger potential with Cigna and Humana, and that is coming after quite some time. It's, the mega merger era of 2015 was really what folks were focused on back when Aetna and Humana were set to potentially link up, and then Cigna and Anthem potentially were in talks. That broke up because of DOJ and federal judge concerns about antitrust, but that is now back on the table with Cigna looking to potentially acquire Humana. One analyst put it pretty bluntly, saying that, this company, meaning Cigna, has been looking to acquire Humana for quite some time. So could they get to the finish line this time? We'll definitely wait to find out. But what this does, and the reason why the stocks really, just sunk on the news, is because of that antitrust concern. We've seen how the FTC has been operating, and FTC Chair Khan has already made it well known that these mega deals are on her radar. So it's definitely something that we'll have to wait and find out.
All right, always jamming on the ones over there. Anjali Kemlani, thanks so much for bringing this to our attention. We'll let you spin around and get back to work over there. Appreciate it. There's also been a lot of movement in the healthcare space, as we were just discussing here in 2023. While investors have typically seen the sector as defensive as it sees constant demand, it's actually down around 2% year to date, and it's been lagging behind gains seen in the S&P 500 more broadly in 2023. It's also seen a lot of consolidation, as we were just discussing, mergers like those of Johnson & Johnson's acquisition of Laminar and Nevro Technologies, acquiring Visra Technologies. Well, here to help us dig into what may come in 2024 in the healthcare space, we've got RBC Capital Markets Senior Equity Research Analyst for Medical Supplies Devices, Shagun Singh Chadha. Great to have you here with us this morning. So let's start there, perhaps. What can we extrapolate from the M&A environment that we've seen in 2023 and kind of apply on a forward basis as we get into 2024?
Yeah, absolutely. And thank you so much for having me here. I think with respect to the medical device universe, I think technology and tuck-in acquisitions is the lifeblood of what the companies do. We have the defensive elements of healthcare, but the tech of the is technology focused. So we expect companies to continue to invest in internal R&D as well as continue tuck-in acquisitions. I think 2023 has been a year where we have seen a lot of tuck-in acquisitions. I think at the tail end of last year, we did see a bigger acquisition with Johnson & Johnson's acquisition of Abiomed. But I think throughout the year, we've seen more tuck-in type acquisitions. And that really lends itself to category leadership. So if you think about companies like Boston Scientific, Stryker, or even J&J, I think the goal is to become a category leader, be the number one, number two player, and be a technology leader in every subsegment. And it lends itself to long-term durable growth in these markets. So as we head into 2024, I think we do have a higher interest rate environment. I think possibly if a company was going to do, a $2 billion acquisition, it could be slightly smaller. But, I think there continues to be appetite for strategics. And, I think tuck-ins are going to continue into 2024.
Shagun, when we talk about the strategy here from executives, from healthcare executives who are out there maybe looking for that next potential deal, that next catalyst here for the company, what are some of the trends that you're noticing in the conversations that you've had with various executives?
Yeah, I think, it's really across the board. So it isn't, one specific sub-market that they are all trying to get into. Like I said, it's about category leadership in any sub-segment you're in, whether it's neuromodulation, structural heart. It's really across the board. Also, in terms of size, it's been interesting because we've seen it across the board. For example, Johnson & Johnson's, CEO has indicated that he has a voracious appetite for M&A. It would be tuck-ins. Given their size, it could be larger. But we've seen it in the mid-cap space, just with reference to Globus Medical's acquisitions of NuVasive. We've also seen in the smaller cap space with Nevro yesterday announcing that they are buying, another company in the implant space to fill the bag. So again, as I get into 2024, I'm pretty bullish on the sector fundamentals, and we can definitely touch on that. But with respect to M&A, I think that's the lifeblood of how medtech company operates, and I expect that to continue as they think about improving their weighted average market growth and then outperforming their markets.
So let's talk about some of the sector fundamentals here. It seems like this is the year that's really kind of had a multi-pronged, or at least a few key themes, but none of them more so than the shockwave that's been driven by weight loss drug and GLP-1s here. Is that set to continue from your perspective, and us just see more research and development, trials move forward, more of these solutions try to be brought to market here in 2024? And if not that, what is one of the prevailing themes that you think could ring true in the next year?
Absolutely. And I do want to step back and talk about fundamentals, because 2023 has been a very strong year for medtech in terms of fundamentals. We've had very strong trends in healthcare utilization. We've seen strong procedure volume growth. Some of our companies like Stryker, Boston Scientific, they are delivering 10% year-over-year growth in markets that typically operate at about 6-7% growth. Part of it is their innovation, but a big part of it is also the baby boomers. As they continue to age, the percentage of spending that goes on healthcare increases from somewhere around 10% to almost 2/3 or 3/4. So, I think that that's a fundamental driver for our companies in 23, and I expect that to continue in 24 and beyond. But with respect to your question on weight loss drugs, that's absolutely, been a factor that weighed on companies in Q3. I think across the board, we saw investors kind of just shun the medical device sector, but we have seen recovery in Q4. I think in Q3, we've really gotten smarter in understanding where the impact lies and where it doesn't. I do expect GLP-1 conversations to continue into 24, 25, 26. I think it's a great class of drugs. But at the same time, some of our TAMs are just massive. So if you take pharma analyst estimates for GLP-1s, it could be about 50 billion in sales. You use the ASPs that we currently have for GLP-1s. You come up with about 10-15 million people who could potentially be on GLP-1s. But if we look at our TAMs, for example, diabetes, we look at cardiovascular disease, we have maybe 500 million to like 1 billion people who could benefit from medical devices. So, and the penetration is really low. So I think the fundamentals of the medtech sector are very strong. I think with GLP-1s, we know that the headwind lies, probably in the areas of bariatric, maybe type 2 pumps. There are tailwinds as well, such as on the CGM side, as well as recon. But then the rest of it, I think obesity is one risk factor in diseases like cardiovascular disease, end-stage renal disease, peripheral artery disease, etc. But it's not the primary risk factor. So, I think there is place for GLP-1s in this world, but I think our TAMs are pretty much intact, and there is very strong opportunities, across the medtech sector. I just want to make the point on valuation, because if you go back and look at the historical 10-year next 12-month PE multiples for our stocks, none of our stocks are trading at peak multiples. Some are trading slightly above average. There is opportunity for stocks that are trading below that average. And arguably the stocks could trade even at a higher multiple because the financial profile has increased substantially. So like I was mentioning, you have companies like, Abbott growing 10%, Stryker, Boston Scientific growing double digits. That was not the case 10 years back. I think the growth profile was mid to high single digits. So we are seeing a strong utilization tailwind that is, critical for the sector, for the top line growth. I expect that trend to continue. And I do think that with any GLP-1 conversations that we have in 24 and beyond, if there are any, fluctuations in stock prices, which we've seen in 23, it's absolutely an opportunity to buy. So I'm pretty bullish on the sector and the opportunities here.
All right, Shagun Singh Shada, RBC Capital Markets Senior Equity Research Analyst, Medical Supplies Devices. Thanks so much.
Thank you.
Well, the price of lithium has dropped 19% over the past 4 weeks, actually, and a 73% fall year to date. While lithium has slipped into a bear market, what's to blame? Softening demand and growing supply, all pushing prices lower. Lithium is a key battery component in the electric vehicle transition. Goldman Sachs notes Chinese EV sales and battery output have continued to rise as subsidies for EVs decline and supply chains normalize, which is negative for the price of lithium. It's not only an issue in China, though. Analysts also saying that EV sales in the U.S. could grow more slowly due to sluggish demand and lack of EVs that meet consumers' demands here. So a lot to really break down as Goldman Sachs and the Commodities research arm over there looked at a few things here. Number one, the rise in chemical output overtaking the growth in the China battery output and China's imports of some of the concentrate that's necessary, particularly from Australia and Zimbabwe, continuing to grow sharply. So all of that creating, or at least part of, the storm that we've seen for lithium prices right now.
Yeah, exactly. And this all ties back to EV demand right now, obviously. When we talk about lithium, obviously the key component there to batteries, you mentioned the slowdown, or really how supply obviously very much outweighing demand, at least at this point. When it comes to what's happening even on a worldwide basis, this new era of EV demand is something that Goldman Sachs really digs into within this report, talking about the fact that we're starting to see this normalization of EV supply chain, and that has really been this key contributor to a fundamental shift, to put it in their words, in battery metals demand this year. Most of the battery metals and components that we're starting to see a softening here in terms of the balance of the batteries for demand and what exactly we had anticipated it to be versus what the reality is here through the third quarter, and then looking ahead to the current quarter today and what exactly it's going to look like going forward. So because of all this, Goldman Sachs saying that they still see downside risk to where levels are trading today, that the market largely balanced year to date, but the full extent of the supply surplus has not yet worked through the system, and something that's going to linger now as we look ahead to 2024.
Yeah, they're expecting the lithium market to be in a 202 kiloton surplus next year. So that's representing about 17% of global demand, and they also continue to expect prices to trade deeply into the cost curve to balance the market.
So it looks like some downside risk here for lithium. All right, we're going to take a quick break, but keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned.
Welcome back, everyone. Brad Smith alongside Shauna Smith. We're about 30 minutes into the start of the first trading day of December, and we're starting the month mixed. Started report. December is usually a strong month for stocks, especially in a pre-election year here. Let's take a look at the S&P 500 here as we begin things this morning. You're taking a look at it flat, just barely to the upside by the hair of its chinny chin chin right now.
All right, let's take a look at some of those individual movers. We got to start with Dell. Now, the tech company reported strong profits, but missed on revenue weakness. And corporate PC demand has continued. And we're seeing that weigh on shares this morning, off just about 6.5%. Still, though, despite that, the company remains optimistic about its next fiscal year, saying that it expects a return to revenue growth, given some of the tailwinds to businesses like improving demand and also AI investment.
And something you don't see every day, Alibaba getting a downgrade on its stock. Morgan Stanley cut its rating on the company's U.S. listed shares to equal weight from overweight, lowering its price targets to $90 from $110. The analyst cited concerns over slower turnaround in its key businesses, as well as the decision to scrap its cloud spinoff.
BioNTech is under a bit of pressure this morning following a downgrade from JP Morgan. They cut their rating to underweight from neutral. Now, the analysts there are saying that they are waiting for a more catalyst-rich period as the outlook for the company's COVID-19 vaccine it made with Pfizer continues to look bleak. We talk about the fact that demand nowhere near where it had been over the last several years, and we're seeing that stock off nearly 4%. Well, Disney has announced it will make a cash dividend payment in return of its dividend to shareholders, and this is happening for the first time since January of 2020. The company suspended the dividend during COVID-19, while the media giant will be making the payment of 30 cents a share to shareholders in January of next year. Now, this comes after Nelson Peltz's Trian Fund Management is moving ahead with a proxy fight at Disney. The activist hedge fund saying in a press release on Thursday morning that Disney extended an offer to Trian to meet with the board, but turned down its recent request for representation, including for Peltz himself. For more on Disney's battle with Peltz, we're joined by Doug Kreutz. He's a TD Cowen's Managing Director of Media and Entertainment. Doug, it's great to see you here. So I'd love first just your your viewpoint on this return of the dividend and this pressure the Iger continues to remain under here from Nelson Peltz, whether or not maybe some of the moves that we have seen or decisions announced in the last couple of days, that's really going to do anything to change some of the mood and sentiment around Disney stock.
Yeah, they had previously announced that they were going to institute a dividend, and they did. You know, their cash position is much better than it was in sort of the depths of the pandemic when the parks were shut down. So there was, no good reason for them not to go back to paying a dividend. I don't think that has anything to do with Peltz. They did change some of their proxy voting rules as well. That is a little bit more of a reaction to Peltz. I think in general, though, I don't know that they feel a lot of pressure from Peltz. He can make noise, but at the end of the day, I think he has less than 2% of the vote. I don't think shareholders in general, while maybe some of the shine has come off of Bob Iger in his second stint, I don't think shareholders really want to see him go, and I don't think in general they think that Peltz has anything to add to the conversation.
Okay, and so of these activist campaigns, what should investors then continue to expect? What kind of weight do you think that they'll continue to give them as Disney right now really has just kind of bounced off of some of those lows? And of course, we've seen it be able to move to the upside with some of the broader market activity over the past month in November. But at the same time, it's still a ways off of where the company had been in some of its year-to-date highs.
Yeah, Iger came back. He cut a lot of costs out of the business. And now he's sort of identified the need for Disney's content engines to start being successful again. They've had a very soft run at the box office post-pandemic after having had an incredibly strong run pre-pandemic. Some of that's just reversion to the mean, but I think that there's been some specific issues at some of the studios that he needs to address in the two plus years that he has remaining to get them back on better creative footing. And again, I don't think external activists have anything to add to that.
Doug, when it comes to some of the headlines that Bob made at New York Times' Deal Book Summit earlier this week, he talked about some of the discussions around the TV side of the business, whether or not those assets he views as valuable here for the company, kind of turning around and saying that, hey, he thinks it actually makes sense for Disney to hold on to these assets. Is that something that you think is critical when you look at the future of Disney and what this company is going to look like 5-10 years from now?
Yeah, he's kind of gone back and forth on it a bit. I think his current position may reflect the reality that even if he wanted to sell those assets, and I'm not sure that he does, there may not be a lot of buyers for them right now. Like nobody really wants to invest in linear television assets right now, including general investors. Like all these media stocks are trading at very low EBITDA multiples. The future of linear television is very much in question at the same time as the level of profitability of streaming is also in question. And with that much uncertainty, there's just not really any reason for anyone to step up and say, oh yeah, I'll take those assets off your hands. I don't think anybody would really think they could run them so much better than Disney's run them that they could, squeeze extra profitability. So I think right now, whatever he feels inside, he's stuck with the assets and he has to do the best with them that he can.
He's also going to have to figure out when this company is going to start communicating to the streets, to some of the investors, as well as those who just cover this company, what new leadership can look like. And at that Deal Book Summit also talked about and confirmed that the succession process that I believe he said is very robust right now and looking to retire at the end of his contract in 2026. Something that we have heard and discussed time and time again. But is there a front runner at this point that's started to come to light from your perspective, Doug?
Yeah, I feel like we've been talking about Bob Iger's succession plan for 10 years now because we have. Look, I think generally up until a few months ago, I would have said they're almost certainly going to pick someone internal. And, the list of names internally isn't super long. But I thought it was very interesting. They had to replace Christine McCarthy as CFO. And they hired the CFO from Pepsi away and brought him in to now fill that job.
Right here.
That was the first external hire of a senior C-level executive that they'd made in almost 30 years. And that was an interesting signal, I thought. I don't know that means that they're willing to consider an external candidate. I still think Disney is a company with an incredibly strong and unique culture, and having someone come from the outside, it entails a lot of risk to that. But they may be more open to it now than they were before. And if that's the case, then, the potential list of people is really long. There's plenty of people who would love to be CEO of Disney. It's just a question of who the board thinks can do the job.
Doug, while we have you, we also want to get your thoughts on a headline that broke this morning. It was a report from the Wall Street Journal saying that Apple and Paramount are in discussions about bundling their streaming services. I know you cover Paramount. Is this a strategy that you think makes sense?
Yeah, look, I think in general, if we're talking about the future of these companies, the best case scenario would be that we essentially reconstitute the old cable bundle where everyone's networks are contained in one product using all the streaming services. I think it'd be better for consumers because they would easily be able to get all the content they want in one place. It's better for the companies because then they don't have to worry as much about user acquisition. And, it also allows people like Apple to promote their own streaming services, not as a standalone product. So I think it makes a lot of sense. And I think you're going to see more of this. I think really it's the only way out of this bind that media has found itself in is to reconstitute the bundle. I don't know how long it's going to take. It's going to be kind of like herding cats, I think, with all the various personalities and companies involved. But I think this is probably the start of a trend. Yeah.
Yeah. All right. A lot to continue to track there. Doug, thanks so much for kicking off the trading session and a new trading month with us here on Yahoo Finance. TD Cowen, Managing Director of Media and Entertainment. Appreciate it.
Thank you.
Thanks. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Markets searching for direction on the first trading day of December. Historically speaking, December tends to be a good month for investors, but are there risks that could derail what's expected to be a strong month for stocks? For that, we went to Jared. Yahoo Finance's Jared Blickery is at the Interactive with more.
Brad, that gets funnier every single time. Thank you for that. All right, we got to take a look at what's happening in December. Memorize this map here, because probably what usually happens is we just get for the first half of the month a little bit of a rise, a little bit of a decline, and then as the market turns into paint dry on the wall, and about as fun to watch that as it is a market, that's when things just start that little creep, I would say. Yeah, I call it a creep into the end of the year. And by the way, the Santa Claus rally is the last 5 trading days of this year, plus the next 2 days of the following year. And let me show you another way, another map of looking at, way of looking at the market. You can look at it in the terms of the VIX. Now, the VIX typically moves inversely to stock prices. So the cyan line is what we expected for the year. We knew this going 1 year ago. And then the purple line is what has actually happened. And this has been a very closely tracking phenomenon that we've seen this year. And that's why we've been talking about seasonality so much. Now, let me get to some of the indices. I was just looking at the year-to-date performance, and a lot of these global market indices, the Nasdaq up 35%, but then we have the Nikkei up 28%. In Spain, the IBEX is up 23%, S&P 18%, even the Bovespa up 15%. So really good swath and, I guess, diversified index collection from around the world. And when we take a look at the sector action, wow, tech up 48%, followed by communication services and discretionary. Those have been the dominant forces this year, but let me show you what's happened over the last month. Real estate is up 12.7%. Financials, there's tech again, there's consumer discretionary again, but also adding industrials and materials to the mix. This bodes really well for the new year, for the strength of this bull market rally that we just recovered from in that correction.
Yeah, and Jared, I think a lot of people out there are trying to figure out how exactly then that is going to set us up for 2024, whether or not some of the trends that we are anticipating here this month, in the month of December, is going to translate and carry over into the new year. What are you expecting, or what are you hearing?
Well, first, I think the comments from Amanda Agati earlier this week, I was writing them up in the morning brief, that the rally, the end of the month rally, the end of the year rally, the Santa Claus rally that everybody's waiting for might have been pulled forward all the way to Thanksgiving. We had an incredibly bullish month in November. This is my leaders board over the last month. ARC up 34%. I've been hammering this home, so I'm not going to go over all the winners here. To the downside, the only loser in this list is small oil, even high yield up 3.7%. So could be that there's a little bit too much enthusiasm right now, and maybe we don't get that rise at the very end of the year. But overall, it would be very unusual to have any kind of major market disruptions. Then heading into the new year, I think entirely different dynamics are going to be at play. We've seen all of this catch up in some of the laggards. That doesn't need to continue once we get to the new year. Hedge fund managers, portfolio managers, money managers are trying to catch up to their benchmarks. They need to hit 18, 20% just to beat the S&P 500. So that chase, that game is going to end at the end of this year. And so that's why I think the new year is just going to be an entirely different trading regime. We'll just have to feel it out and see what comes of it.
All right, Jared, thanks so much for breaking all of that down. We will have to wait and see exactly what unfolds over the next month. And then, of course, looking ahead to 2024. Thanks, Jared. Well, we've got all your market action ahead. Stay tuned. You're watching Yahoo Finance.
More and more companies are doubling down on the future of AI, and Hewlett-Packard Enterprise is no exception. At HPE Discover Barcelona, the company announced several AI and cloud computing offerings, including an expanded collaboration with NVIDIA. Hewlett-Packard Enterprise CEO Antonio Neri joins me now from Barcelona. Antonio, busy week for your company. Thanks for taking a few moments for us here. So let's start on this partnership with NVIDIA. What exactly did you announce?
Well, good morning, Brian. Thanks for having me. We're just wrapping up another amazing HP Discovery event here in beautiful Barcelona. I can tell you it was an incredible week for us. We engaged more than 3,000 customers. And obviously the biggest news was the expanded partnership with NVIDIA. 2 weeks ago, almost 3 weeks ago now, we actually announced a turnkey solutions with NVIDIA at the time for what we call the model developers. And this is all about helping accelerate mobile training with our supercomputing technologies, including a networking fabric and our software, and the NVIDIA Grace Hopper H200 and their software. Now here in Barcelona, we expanded our partnership to now address the needs of enterprise. And think about it this way in the context of the AI lifecycle. You have model developers that are training models, but enterprises are going to fine-tune those models with their data, and they want to do it in a secure, private, and safe way. And what we did with NVIDIA is announce a specific enterprise turnkey solution that actually leverage our portfolio, including HP GreenLake, in order to deploy an AI native architecture on-prem, so they can leverage the cloud native world where all the data is with an AI native world on-prem, so they can speed time to value. Very exciting.
For the lay person out there, Antonio, what is this deal with an NVIDIA? What is that, or how does it change your financial outlook over the next 2 years?
I mean, it's an acceleration of what we're doing. If you recall, Brian, over the last 5 years, have been talking about the transformations enterprises are going through, and I said that enterprise of the future will be edge-centric, cloud-enabled, and data-driven. We saw results at the end of 2023, early this week. We had a massive acceleration of the edge, now represent 20% of the company revenue, almost 50% of company profit. We enacted HP GreenLake, which is a hybrid cloud platform to accelerate deployment of cloud everywhere across the enterprise. And now we are in that data-driven journey. And together with NVIDIA, we bring enormous expertise. We have a partnership for decades where basically we have been addressing supercomputing requirements. Now we're going to democratize that with their technology and our solutions, including our services expertise, which is an incremental, critical component of what customer needs to democratize AI and leverage this amazing technology to accelerate business transformation. So, if you think about our results in 23, at the beginning of the year, we had less than $100 million in AI orders. At the end of 23, we actually booked $3.6 billion. So 10 months, huge growth.
Yeah, and just playing off that number, Antonio, and maybe it's hard to explain, at least I find it hard to explain. Things just feel like they're moving very fast in AI compared to where they were a week ago, 2 weeks ago, 3 months ago. And I bring that up because Jensen this week said, we're almost arriving at that point where 5 years from now, a lot of AI solutions or computing processes will be on par with the human mind. I mean, do you share that sentiment?
I agree with Jensen, and Jensen and I meet regularly, almost on several weeks, not anymore months. And the reason why is because we believe on the opportunity. We believe on the use of this technology in an ethical and responsible way. But at the same time, the pace of the innovation we are seeing, I've never seen before. Think about when mobile came along. Think about when Web 1.0 came along. It took several years, maybe a decade or so. This is happening now weekly and monthly to a pace that we haven't seen. So I believe we're going to achieve major breakthroughs over the next several months. Think about ChatGPT-3 as an example. It was in the hundreds of billions of parameters. Now it's over 1 trillion parameters. But ultimately, as the model becomes more intelligent, context aware, we're going to achieve new breakthroughs in ways we haven't imagined before.
What does a breakthrough in AI look like for next year?
Well, I think we see several trends, right? So as we think about the convergence of what I call cloud native and AI native worlds, in AI specific, let's see the convergence of generative AI with simulation and modeling. Historically, we have used simulation and modeling to address some specific requirements where it was kind of simulate what a testing will look like or a manufacturing process will look like. It was more about creating digital twins for the physical world. But now with generative AI, we give a lot of intelligence to that, and therefore we can accelerate the outcome of these models and provide automation and decision-making capabilities. The question is, how far do you want to go with that decision-making? And this is why there is a step between training and tuning, which we call prompt engineering, which in some cases, like you do with your ChatGPT, if you want, you just enter a prompt and it gives you an answer. But in the future, you can actually automate that prompt engineering based on requirements, and you can actually automate that execution, if you will, right, through the inferencing side. So we think about this not just in the context of large language model, we think about this in the context of molecular docking foundation model, climate research, simulation and modeling, diffusion. Things are actually probably for the society easy to understand than just a large language model. But this convergence is happening right now, and we as the market leader in supercomputing, we see that convergence, which actually creates a massive opportunity for us, because this is an inflection point where HPE is uniquely positioned with intellectual property and expertise to capture that moment.
Each time we have talked this year, Antonio, I have come away thinking increasingly that HPE is a really strong play on AI and where AI is going. And I think this conversation just furthers that thought along. As the CEO of HPE, do you look at your portfolio and think, maybe there's certain areas we no longer need to play in, and these parts of the business are not where we're going into the future, and maybe we shouldn't have them in our portfolio?
We always, is my fiduciary duty and the fiduciary duty of our board to always look how we can accelerate value for shareholders. It is a context where we invest money, where we divest, where it makes no sense, and ultimately where we're going to grow as I think about 3, 5, 10 years out. And as you and I have discussed multiple times, all comes down to relevancy. Is not just financial engineering, and that's why a strategy that's innovation driven is the core. So as I think about our business, we have 5 businesses, right? The compute business, the traditional server business is very commoditized, but give us scale. And honestly, give us a lot of free cash flow that we directly contribute back to shareholders, or we use to invest in growth engine. And I see 3 distinct growth engines for us. One is the intelligent edge, and you see the results, which actually created an incremental $2 billion in just 18 months, and actually at a massive operating profit. So that, to me, is the core fabric of the company, is the networking layer. The second is the hybrid cloud. And as you saw in our 2023 results, we went from very little to $13 billion in total contract value in less than 6 years. And that's the foundation for which we create the data, manage the data, and now we can accelerate with the third growth engine, which is AI. And we have the expertise to do so, but also we need to allocate capital correctly. And if I think about the results of 2023, we actually delivered record-breaking performance in non-GAAP diluted net income per share and free cash flow in the history of the company. So we are on the right path, but it's always about the discipline applied on return on invested capital.
Our thanks to Antonio Neri, Hewlett-Packard Enterprise HPE CEO, and of course our thanks to Brian Sozzi, Executive Editor, for bringing us that interview. All right, well, it has been a tough year for consumer staples as higher prices take a toll on customers. But could 2024 be a turnaround year for the sector? We want to bring in Yahoo Finance's Brooke DePalma. And Brooke, you and I were talking about some of the trends that we've seen from these consumer staple companies here over the last several weeks. And very similar to what we've seen with the retailers on the apparel side, consumers are trading down. They're not willing to spend as much as maybe they once were when they head to the grocery store or something like that, just in terms of buying the food and the goods that they need. What do you think that then tells us just about the strategy for these companies going forward, and taking Kroger, for example, and the reliance on Albertsons and that deal getting through?
Yeah, I think that there's so many questions heading into 2024 about how exactly grocery companies, how exactly consumer staples like Coca-Cola, like Kraft Heinz, Hormel Foods, so many others are really going to position themselves to make sure that they're providing value, make sure that they're keeping traffic in these Kroger stores, in these other grocery retail giants, while also keeping in mind that we're seeing grocery deflation. Everyone's wondering, was this the peak of higher prices? Has this finally lapsed where they no longer have the power power in order to raise prices and still keep consumers wanting more. And so with those all in mind, I mean, we just saw Kroger now expect fiscal 2023 sales to grow 0.6 to 1%. That's down from their prior forecast to the low end of 1 to 2%. And in a note from JP Morgan, they said that these headwinds up against Kroger may not go away immediately, or they could even get worse. And I think that really, when you think about just how much these retail groceries, the power that they have to continue to raise prices while consumers are pulling back, everyone's wondering that same question.
Yeah, they said in the statement, the third quarter results highlight the strength and diversity of the business model, but a challenged operating environment. Some of those points that you were noting to a moment ago here. While we're in this space, though, let's talk a little bit about food delivery workers. In New York, they got a win yesterday. What do we know about this win? How far-reaching is it expected to be?
Yeah, so Uber, DoorDash, Grubhub, other delivery workers in New York City will now have to pay their delivery workers at least $17.96 an hour after they failed to convince an appeals court to block that minimum pay rule. Now, I did just hear back from Grubhub in a statement that they said they were disappointed with the judge's decision and are evaluating their next steps. And DoorDash spokesperson telling a similar anecdote, saying that the sad truth is that the court has chosen to ignore the harmful consequences such as a misguided minimum pay rule will cause, and fail to justify its decision to allow the city to pick winners and losers in how it is applied. Now, I can't help but think of what's going on in California with the FAST Act. Their fast food workers also will have to increase the minimum wage. And like we're talking about grocery retailers trying to figure out 2024, all these delivery workers, these fast food companies are really trying to figure out how they're going to go about wages in 2024, what this means for California, what this means for here in New York City in the delivery space. I mean, what does that mean then for consumers? Will they end up having to pay more? How will they offset these higher wages? I think wages is going to be a big story in 2024.
All right, we're going to continue to watch that very closely here. Brooke, thanks so much for bringing these stories to our attention, continuing to track them, as well as many others. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Renaissance, a film by Beyonce, premieres in theaters today. Parts documentary, parts concerts, the film is projected to pull in upwards of $20 million in its opening weekend. It's hot off the smash success of Taylor Swift's Eras Tour movie and comes during the historically slow post-Thanksgiving period for theaters. We're joined now by Sean Robbins, Box Office Pro Chief Analyst. Great to have you here with us. So the expectations, lay them out for us here for the Renaissance Tour film.
Yeah, thanks for having me back. This is, in the wake of Taylor Swift, it's kind of hard to live up to that performance a few months ago at the box office, but this is still a significant release for movie theaters, one much like Taylor Swift that nobody really expected. And for Beyonce to come out, put this film out there, bring out her fans, it's kind of a welcome injection of content on the big screen during a time we don't usually see a lot of that right after Thanksgiving and a few weeks before Christmas. It's kind of a dead zone for cinemas. So every little bit is kind of welcome news for theater owners, and Beyonce is certainly the kind of artist that will bring out fans.
Sean, when it comes to the debut expectations, we have some expectations or some estimates, I should say, on the screen. What are you expecting to see in terms of how it's going to stack up versus what we saw with Taylor Swift?
Yeah, I think it's going to land somewhere in the middle of that range. It seems like a little bit of a wide range, and in some context it kind of is, but there's a lot of volatility to projecting this type of movie because there are so few concert films in modern day times. We look at the pre-sales, it's been very front-loaded, much like Taylor Swift's was. We saw a lot of those happen early on as soon as tickets were available. With Beyonce, the same thing has happened, and that speaks to both of their fan bases in a lot of ways. But I do think we'll end up seeing a debut somewhere in that range domestically. Worldwide, we could be looking anywhere from 25 to 30 million, if not a little bit higher.
Is this the new normal, Sean? I mean, am I just getting dressed up to go see every motion picture in theaters now? I got to get dressed up for this now, too.
Maybe it is. I don't know. Every time it seems like we're talking about something. Last year, people were dressing up as Minions. This year, people were dressing up as Barbie and Oppenheimer. Now we're talking about Taylor and Beyonce. I don't know. If it adds a fun aspect and if it brings people out to theaters and go do something together like that, I'm all for it. Why not?
Sean, do you think it's going to be, when we talk about bringing people back to theaters, yes, maybe some people who went and saw Taylor Swift's concert in theaters or are planning to go and see Beyonce this weekend, maybe they haven't returned to the theater since pre-pandemic, since what we saw back in 2018, 2019. How big of a boost do you see this being in terms of that step towards recovery for the box office?
Sure, it certainly adds kind of a new metric to look at. I think with Taylor's film, we saw a lot of moms and daughters go and see that. And of course, we've talked a lot about how younger generations of moviegoers have come back since the pandemic and been a real, kind of a linchpin to the success of theaters. But it's been older audiences that have been slower to come back or a lot more selective in the movies they go see. It's been a year and a half since Top Gun came out. It's been a few months since Oppenheimer. So I think them coming out to see, Taylor being kind of a multi-generational film, Beyonce might have a little bit of a similar pull. We'll see how it goes. I think it's just so hard to compare them. They're two very different artists.
Even in some of the strongest times for movie theaters, there were still the types of polls or the promotional environments that they had to really implore to make sure that they were still getting people into the theaters. And, some of those had created entire business models that were just not sustainable, that fell by the wayside. We're looking at you, MoviePass. But at the end of the day now, when you think about the number of people that are AMC Stubs members, the number of people that have bought into this rewards type program, how strong is that holding up for the theater chains and operators? And is that enough to kind of buoy them if they're not seeing the same type of foot traffic that they had become accustomed to pre-pandemic?
That's such a great question. I think it absolutely has been a positive side, especially for the major chains, AMC and Regal. They lean on those subscribers because in slower times, people can look on that subscription and say, okay, I've got access to go see a movie. Let's just see what's playing right now, even if I don't know about a big Marvel movie, or I don't know about Barbie or Oppenheimer or something like that that's big out at the time. And in this new world where I think, especially post-pandemic in a streaming world, as I mentioned, some people are a lot more selective about what gets them motivated to go out and see something in the theater. And eventizing things like that is partly attributable to the memberships, to the rewards programs, to being able to pay $25 a month and having access to go see at least one or two movies a week, if not more. It's things like that the industry is really starting to embrace, and I think it's going to be a big part of their future because this is a new world. And as much as success I think lies ahead, it's also, probably realistic to never expect things to go back to the way they were. So there has to be some adaptation there.
Sean, how are you looking at the importance of release dates surrounding holiday weekends? And I bring that up because of what we saw play out over Thanksgiving weekend. A bit of a disappointment when you look at the performance here, especially what we saw from Disney's Wish. When studios are thinking of release dates, how much, I guess, is it as big of a priority, some of those coveted holiday weekends, as they had been pre-pandemic?
Yeah, that's a great question too. I think with Disney's case, it's a little bit tricky right now. Their struggles, in particular with Wish last week, come down to more of a branding issue and more of how consumers see them now. As I mentioned, it's a streaming world, and Disney in a lot of ways is the best example of that, because they've essentially trained consumers to expect their biggest and best content free to stream within a few months if you have an $8, not $10 subscription at home. So, but strategy and timing is still very important. I think we saw Napoleon do really well over the holiday. We typically do see that with a big high profile adult movie, and we'll have Wonka and things like Aquaman later this month with varying levels of expectations, of course, but it always comes down to the content. Does it scream being important? Does it need to be something I need to go see in theaters? I think that's how people approach movies even more nowadays. Is it something that's getting good reviews? Are my peers, my friends, my coworkers talking about it in a positive way? More and more that's important, but it always helps to be around a holiday or just any time on the calendar, I think, can support a good movie. It just comes down to those other factors.
All right, Sean Robbins, always great to get your insight. Box Office Pro Chief Analyst. Thanks so much, Sean.
Thank you.
Well, while the box office struggles to get back to pre-pandemic levels, this year, 2023 has been another step towards recovery. This summer, Barbenheimer craze brought the fourth largest box office weekend of all time, and Taylor Swift's Eras Tour film became the highest grossing concert film of all time. But it wasn't quite enough to bring 2023 ticket revenue back to those pre-pandemic levels. We have Beyonce's concert film, which is going to be released this week and has been released. Could this be just another tailwind here that the movie theaters desperately need? We want to bring in Chad Beynon. He's Macquarie Group's senior analyst. Chad, it's great to see you here. So lots of hype around Beyonce's new film that has been released here this weekend. How big of a win do you see it being for the movie theater chains?
Thanks, Shauna. As was just covered, I think, Sean was pretty spot on there just in terms of how we're thinking about this weekend. We do need something different. That's kind of what we got with Taylor Swift a few weeks ago. The second and third quarter were actually really good quarters for the industry. We saw domestic box office above $2.5 billion, which is where it was in 2019. Unfortunately, for the fourth quarter, we do expect a little bit of a dip here. There is a lull in the season here. We're not seeing the complete breadth and depth of product, and we're expecting closer to $2 billion of box office for Q4. We actually just brought down our estimate, and as a consequence, we also brought down our price targets for Cinemark, ticker CNK, AMC, and IMAX. We still do like Cinemark and IMAX just given the business model, but it was a little disappointing just in terms of what we saw in October and November results.
So are there any winners on the horizon for the movie theater operators here when you continue to think about and evaluate the slate of titles that are expected in 2024?
Yeah, for 23, the total amount of product was back to about 80 to 85% of pre-pandemic. So that's the number of widely released titles. For 24, I wouldn't expect that to be much different. First quarter is going to be a little bit of a drag just because of what we saw with the strikes. So some of it could be backfilled loaded. We did bring down our estimate for 24 from about 10 billion of box office down closer to 9.7 billion. In terms of who could be the winners, we still like the companies with the best business models. So that would be IMAX and Cinemark at this point.
Chad, when it comes to the Hollywood, the strike that we saw play out and exactly the impact that it's continuing to have when it comes to release dates, how big of is that at all going to move the needle in terms of maybe some of the pressure that we had been anticipating, and it won't be as bad as maybe some had feared?
Yeah, I think there's still opportunities for some movies to fall into some windows where we don't have a big release. This weekend's a big example of that with Beyonce. This was a nice surprise, getting something in this weekend, especially after last week. I thought, Napoleon, Hunger Games, Wish, it could have been a bigger result with some nice legs there. The results were a little bit below expectations. For 24, I do still think there's some opportunities. What we're seeing is the amount of $100 to $300 million movies are about the same. Where we're seeing a gap is the 300 plus, which are obviously harder to predict, kind of the Barbie and Oppenheimer, the Top Guns, those big, well-marketed, well-budgeted movies. And then some of the smaller films just outperforming. So where we'd like to see a little bit more is on the big releases. With Napoleon, for example, I don't think it was as marketed as it could have been. And that's maybe one of the reasons why it's coming in shy of what could have been a huge box office hit.
Chad, is there an operator from your perspective that just knocks it out the park with the movie theater experience and is seeing that cascade through to some of the margins as well at the end of the day? I mean, they're not getting me on concessions. I'm going to figure out a way to sneak my Chipotle burrito in there. But perhaps the next person is willing to pay for some overpriced popcorn.
Sure. Well done. Yeah, I'd say, Brad, what we're seeing is Cinemark continues to perform the best in these environments and box office quarters that are very strong. They're seeing 20 to 25% EBITDA margins, and that's 500 to 700 basis points above AMC. So we think Cinemark's model, being slightly outside of urban markets, kind of in the big suburban areas with lower rents, lower expenses, that model portends well for margin expansion. And then IMAX is essentially a franchisee company. I mean, their margins are incredible just because it's their equipment that's in another operator's theater. And those are the reasons why we like those two and why we still have an underperform on AMC. Until we see really good attendance, it's tough for the AMC model to work. And that's why we just brought down our estimates for 24 and 25 for AMC.
All right, on the other side, there's some welcome news to the ears of Yahoo Finance friend of the show, Richard Gelfond, who joins us from time to time, IMAX CEO, to break down what they're seeing over at the company. Chad, thanks so much for the time here. Are you seeing Beyonce over the weekend?
Potentially, yes.
Yes.
I'm trying to get tickets. Yeah, $22, right in the price range. Tough to see in a premiere experience, though. If you haven't done it in IMAX, you have to do it, but get in line.
All right. Well, I'll teach my price hedge, my price hedge strategy of sneaking in a Chipotle burrito. Perhaps that will help with that ticket purchase as well. Chad Beynon, who is the Macquarie Group senior analyst. Thanks so much for the time, Chad.
Thanks, Brett.
Appreciate it. Everyone, we've got all your markets action ahead, as well as some tips on how to sneak in food to movie theaters on the other side. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance. Much more coming up in our next hour here on Yahoo Finance. It's a wrap on the November rally. Who were the market's biggest winners and losers? And will December see the same upward momentum?
And an all-out ban on TikTok struck down in Montana. What this decision means for the app's future in the U.S.
All right, TikTok there. Plus, as FOMC members prepare for a blackout period ahead of their December meeting, Federal Reserve Chair Jerome Powell, J, set to speak shortly. Investors will be eagerly watching for insight into the Fed's policy pathway forward.
All right, let's take a quick look here at the markets 90 minutes into the trading day ahead of Fed Chair Jay Powell's comments here. We're looking at pretty much a mixed picture still. You have the Dow up just about 58 points in terms of the leadership there. Salesforce, the leader in the Dow once again today, up nearly 3%, followed by Chevron and Walgreens. Comparing that to the downward momentum that we're seeing in the S&P and the Nasdaq. You look at the Nasdaq off just about 0.3% on the first trading day of December. Well, that does it for us today, but keep right here on Yahoo Finance. Akiko Fujita has you for the next hour. Have a great weekend.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita. Here's what we're watching on this Friday. Stocks looking good looking to mirror a strong November as we head towards the end of 2023. We're going to take a look at some historic end-of-year calls. TikTok's legal battle. A federal judge strikes down Montana's attempt to ban the social media app, but its ongoing fight with the state likely far from over. Plus, world leaders gather in Dubai for COP28 to assess the climate crisis, with a sharp divide already emerging over the future of fossil fuels. First, though, let's take a look at where markets are trading 90 minutes into the trading day on this Friday. A bit of a downbeat note here, though the Dow trading pretty flat after ending November at a 2023 high. The Dow down 10 points, the S&P 500 down 9, and the Nasdaq down 64. We are seeing these numbers on the back of the ISM survey coming in today, showing no pickup in manufacturing activity in November. That index remaining below 50% for 13 consecutive months now. We're also keeping a close watch on Treasury yields today as we listen to Fed Chair Jay Powell speaking over at Spelman College. At this hour, you see the 5-year, the 10-year, and the 30-year all down, although well below that 5% level. Well, stocks had a great November, ending the month with a rally, snapping a 3-month losing streak. Question today, can this momentum continue into the year end? Let's bring in our very own Jared Blickery here with some insight. Jared, tell us you've got some positive news.
Akiko, I have some positive news. I will get to that in a second. I'm just kidding here. December does tend to look up, and we've been talking about seasonality plays for a long time because they work so well this year. Up here, I have in cyan what is expected for a pre-election year. This goes all the way back to 1950, but why pre-election? That is a third year of the presidential cycle. Next year, an election year, would be year 4. Anyway, the cyan line is what we might have expected, and the purple line is what actually happened. A lot of the zigs and zags nicely lined up. We had that huge rally into the July time period, and then we just kind of fell off into November, and then we picked up right back where we left off and really surged here. In terms of what we're expecting for the new year, I just want to throw up a new chart here that I just created, really excited to show you. This is the S&P 500 going back to 1990. It is a log scale, so that accounts for what you're seeing in the y-axis, but what I want you to focus on is the coloring. When I have it in red, that is a period when the VIX is under 15. Now, right now, the VIX has been around 12 or 13, very low levels, and I just want to show you that has been conducive to big rallies in the past. There you have in the 90s, the early 90s. We have this in the run-up to the global financial crisis. We had this after the QE era going all the way back into the pandemic here. And we had a little one-off right here. What's interesting to me is that we are right back up into VIX lower than 15 territory. That means we might expect monster gains in the years to come. Now, anything can happen in the short term, and I would also point out that we did have this one-off down here. That was in 2011, right before we got that debt downgrade by S&P, and we did get a 20% sell-off there. But aside from that, this has portended monster rallies in the S&P 500, so that probably does bode well over the longer term. Now, what we might expect for December, let me just show you what happened in November real quickly. This is over the last month. Real estate really picked up. That's up 12.7%. Then we had tech, financials, consumer discretionary, industrials, materials. But what happens in December, this might be considered a game of catch-up. December is when things quiet down, and we actually see the defensive sector of healthcare. That tends to outperform in December. So does energy, so does consumer staples. What doesn't work well typically is tech in December. Now, anything can happen. We're just talking about seasonality plays here, but historically, tech has had a rough time in December. Last caveat I'd throw out is that because of the monster rally we had in November, that might have brought forward some of the potential enthusiasm we have for the end of the year rally. So if we did get that turkey rally in lieu of a Santa rally, things might just peter out into the end of the year. But again, things looking pretty bright for the new year. For all the talk of recession, didn't manifest itself this year. And just looking at the tape doesn't want it to happen next year.
Investors certainly hoping for a repeat of what we saw in November in December, but we will be watching that one. Jared Blickery, thanks so much. Well, Federal Reserve Chair Jay Powell speaking right now at Spelman College in Atlanta, Georgia. Our very own Jen Schomburger is following the details there for us. And Jen, we've already heard the Fed chair push back against those expectations that the Fed's done with raising rates.
Good morning, Akiko. That's right. Fed Chair Jay Powell speaking right now at Spelman College in Atlanta, warning markets that it would be premature to conclude that the Fed is finished raising rates or speculate on when rate cuts could begin. He said that while the Fed is encouraged by the decline in inflation, the Fed still needs to see more further progress to feel fully confident that the policy rate is high enough to continue bringing inflation back towards the Fed's 2% target. He said that while the policy rate is well into restrictive territory, that, quote, it would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. We are prepared to tighten policy further if it becomes appropriate to do so. Now, Powell's comments coming just after the Fed's favored inflation gauge core price consumption expenditures index showed inflation was running at 3.5% in October, down from 3.7% in September. Powell highlighting from that very report that over the past 6 months ending in October, core inflation ran at an annual rate of 2.5%, something for the doves, but he cautioned that while that lower reading on inflation is welcome, progress must continue if the Fed is to reach its 2% goal. Now, Powell also said that he believes the full effects of the Fed's rate hikes have yet to kick in. He reiterated that the outlook for the economy is unusually uncertain, and as a result of that, the Fed will proceed carefully. He said the risks to over or under tightening have become more balanced, so suggesting that the Fed will hold rates steady at the December policy meeting in 2 weeks' time. Now, he said that he and his colleagues believe that growth and consumer spending will slow over the next year as the effects from the pandemic fade and as the Fed's aggressive rate hikes continue to slow growth. Powell reiterated that decisions will be made on a meeting-by-meeting basis based on the totality of the data. Akiko?
Jen, it's been a very busy week of Fed speak. You've been monitoring all of that. Based on what we're hearing from Fed Chair today and what we heard from Fed officials earlier this week, I mean, what does that tell you still about how divided the FOMC is?
Yeah, I think that Fed officials are now in a place where they're feeling more comfortable given the inflation data, but they still need to see further progress that what we saw over the past couple of months is going to continue before they feel fully confident in taking language off the table that rate hikes are no longer needed. And as far as rate cuts, they're saying, well, hold on a second here, like we're not even there yet. Once we answer the question of whether rates are high enough to feel confident that inflation is coming back down to 2%, we are going to hold for a while before we even consider cutting. So once again, the market's getting ahead of the Fed and the Fed chair sort of trying to pull that back a bit, as we saw from New York Fed President John Williams yesterday and other officials this past week.
Higher for longer, the consistent message there. Jen Schomburger staying on top of it all for us. Thanks so much.
Thanks.
Well, shares of Worthington Enterprises are jumping today after successfully spinning off its steel processing business. The company is hoping to keep the standalone Worthington Enterprises more focused as a designer and manufacturer of building products, consumer products, and sustainable energy solutions. Worthington Steel begins trading on the New York Stock Exchange today under the ticker symbol WS as a standalone metals processor. Worthington Steel is also set to replace Sleep Number on the small cap 600. Well, all your markets action ahead. Stay tuned. You are watching Yahoo Finance. Fed Chair Jay Powell pushing back against expectations of a rate cut. Speaking at Spelman College this morning, this comes as bond investors grow increasingly concerned about the ability for the Fed to deliver that soft landing. Last month, U.S. Treasury bonds tracked its biggest drop in yield since August of 2011. So can we expect more upside in the new year? Let's bring in Lindsay Rosner, Goldman Sachs Asset Management Head of Multi-Sector Fixed Income Investing, joining us to weigh in this morning. Good to talk to you today. Let me just get your reaction to what we're hearing from the Fed chair. On the one hand, we heard from Fed officials earlier this week sort of setting the expectation here that things may be done in terms of rate hikes. And yet here you've got the Fed chair himself saying not so fast.
Well, I think they have to be careful, right? It's been very difficult to figure out the perfect trajectory of how inflation is going to go and how the economy is going to respond to rates being higher. So I think Powell is doing exactly what he needs to do, which is say we have to look at the data. We have to be open to what happens next. That being said, we believe at Goldman that July was in fact the last hike and that we are seeing a soft landing. The recession probability has come down. All of this provides a beautiful backdrop for fixed income heading into 2024.
Yeah, so how do you see that backdrop playing out? I mean, if you were a bond investor earlier this year, you saw some big gains.
Especially November has been not only a great month, as you were speaking before about equities, it's been a really strong month for bonds as well. It's taken total return in many cases to positive on the year. And as you go further out the risk spectrum into things like high yield, bank loans, even better, how we think this all plays out going forward in 2024 is we're in a very different spot right now than we were at the beginning of 2023. And what I mean by that is that we have duration as our friend. Said another way, interest rate sensitivity, how that can affect your portfolio, the downside is much smaller than the potential upside. And that asymmetry is a good one. And so for bond investors, we think that you're looking at a year of numbers like 5 or 6% total return in high quality fixed income. And if you want to go into the lower rated companies, you can be looking at returns like 8, 9, 10%. That's a great place to be. And fixed income is supposed to be a good ballast in your portfolio. And we think you're really going to see that this year. And that therefore 2024 is in fact the year of the bond.
So we can talk a bit more about what you think that bond or that fixed income mix should look like in the portfolio. But as we track Treasury yields today, I mean, we have seen a huge pullback, at least in the month of November. Where do you expect them to track, at least in the medium term? Is this talk about a 5% yield sort of done for now?
I think at this point in time, we're going to trade in a range. And 5% does feel like something of the past, and that where we are now feels like the right zip code, especially in the front end of the curve, so the shorter yields. Why those yields have come down is because we're starting to see data that's really corroborating the soft landing story, meaning that the Fed has sufficiently tightened policy, that they have brought down inflation, but they haven't crushed the economy. That was really the concern that led to the move up in yields, that, oh no, inflation is really out of control. How's the Fed going to respond? Where are we going from here? Now we're seeing that this is all really working, and I think Powell will be corroborating that today. So now the economy feels okay, and the market feels more confident that the Fed can say the job of hiking is done, and now they have to figure out how long they're going to hold. And our belief is that there are maybe a few too many cuts, priced into the market, but that by the back half of 2024, the Fed can begin to bring down that policy rate because it was restrictive enough. So we think as a result, yields in the front end are probably going to come a little bit lower. But what we do think is yields in the back end of the curve may move higher. And so you're going to get that yield curve steepening that we've been seeing. As a result, we think it's very important to have an active manager in fixed income to make sure you pick the right parts of the curve to set you up for how this next year is going to play out.
So, Lindsay, given your expectations going into 2024, what does that fixed income portfolio look like? I mean, you already mentioned sort of the longer end of the yield curve, one way to play it, but corporate bonds as well. What's that mix for you?
Sure. So our mix that we think is going to perform best is really intermediate high quality fixed income. That is an area of the fixed income market. We're talking investment grade corporates, agency mortgage backed securities, high quality structured products, all different flavors of investment grade high quality bonds in somewhere between the 5 to 10 year duration or part of the curve. That will give you something like 5 to 6% yield, and that should be really attractive. So being in that middle part of the curve and getting a good mix, a diversified group of assets will serve you well.
Certainly a lot of people taking notes after the year we've had. Lindsay Rosmer, Goldman Sachs Asset Management, Head of Multi-Sector Fixed Income Investing. Good to talk to you on this Friday. Have a good weekend.
Thanks for having me. You as well.
United Healthcare made headlines after saying the company has ties to 10% of all physicians in the U.S. The country's largest health insurer disclosing that number at its Investor Day this week. For more on this, let's bring in Yahoo Finance's Anjali Kamlani. Anjali, what are the implications of this?
Well, as you would imagine, having a tie-in with one of the largest insurers in the country just means that this is really adding to United Health's strength. The company has boasted in the past that it reached 70,000 the year before, and so now adding to getting to the 90,000 mark is just another milestone for it. This now compromises 10% of all active physicians in the United States, which is about 950,000 according to the American Medical Association. What this really is interesting for is it kind of tells the story of where United Health is headed as a vertically integrated company focusing on healthcare services and sort of keeping everything under the umbrella of United Health. That's been something that's been a concern for many over the years and really is part of this trajectory that this company could be one of the largest, not that it isn't already, but could be one of the largest in the country. I've had some experts tell me United may well be the first $1 trillion healthcare company, and it certainly seems with the works that they have, with the things that they have in the works, it could certainly meet that.
Where does that leave some of the other big health insurers then?
Well, we already know that CVS is also ramping up its provider services. It recently acquired Signify as well as Oak Street. And so you see that effort there. Meanwhile, they also have the Minute Clinics. So these two are really the main competitors in the space. We also know about the rumored Cigna-Humana deal. Humana does have its own primary care with really focusing on senior care. So that's where a majority of the focus has been. So United does have sort of a head start, if you will, in this space. We've also seen other healthcare giants like Walgreens signal that they're interested in getting into the provider space, as well as, of course, the Amazon One Medical tie-up. So a lot of this is really shifting what we think of as how provider services are provided here in the country.
Yeah, fascinating to be tracking that shift. Yahoo Finance reporter Anjali Kamlani, thanks so much for that. Well, all your markets action ahead. Stay tuned. You are watching Yahoo Finance. Investors are pushing back against the Federal Reserve's higher for longer rate message as we go into the last month of the year. And while they're out, they are watching out for Fed Chair Jay Powell's comments today and looking to the December meeting. Debate over achieving a soft landing persists. Our next guest thinks that the risks to our soft landing baseline look balanced. Let's bring in S&P Global Ratings Global Chief Economist Paul Grunwald joining us on this Friday. Paul, good to talk to you today. So if things look balanced, what does that ultimately mean? Is the Fed going to stick the soft landing?
Yeah, well, thanks for having me on the show. We think that's the most likely scenario right now. We've continued to underestimate the strength of the labor market in the U.S., and that's really the secret sauce. As long as services spending remains robust and as long as the labor market, which is driven by that, remains robust, we think that the Fed can slow the economy as a result of their rate hikes and, get down to a more sustainable path. We're going to have to grow below potential, kind of 1.5-ish for a year or so to take out the excesses. But for us right now, that's the most likely scenario.
There is a bit of messaging happening, obviously, from the Fed chair today, trying, as he sees the market kind of run ahead, not just on the expectation that the rate hiking cycle is done, but that there could be cuts going into next year. I mean, how do you see some of the messaging coming through today as the Fed tries to keep optionality available?
Right. That's a bit of a balance because the Fed controls the short-term policy rate, but they want the markets to do the actual work through the financial conditions. So when the Fed or any central bank starts to tighten, that has an effect on yields and spreads and asset prices and everything else. If the market starts to ease too early and we see bond yields fall, for example, that eases financial conditions too early and kind of increases the probability that the central bank has to do more. So I think the Fed would prefer not to do more at this point and let the markets do the work. But the job of the markets now is to kind of keep those financial conditions tight enough to slow the economy. And if we're continuing to see drops in bond yields, that's kind of going in the wrong direction.
Yeah, I was going to say that. I mean, if you think about easing, we have seen those bond yields pull back pretty rapidly, at least in the month of November. Is that a concern for the Fed, or are we still kind of at this rate where they feel comfortable with where the market is headed, at least on the yield side of things?
Yeah, we think the December meeting's kind of not a toss-up, but there's still a chance the Fed may have to tighten more. But again, if the financial conditions in the market aren't restrictive enough to slow the economy in the judgment of the Fed, they'll have to do more. And by the way, this is not just a Fed issue. We've heard the same from senior folks at the European Central Bank as well. So again, the central banks control that short-term instrument, but they need the markets to generate those tight conditions. And if the markets kind of get ahead of the game, as you said, and try to ease things too early, that just makes the central bank's job harder and kind of raises the likelihood that they may have to tighten a little bit more.
You mentioned the expectation going into next year. Sure, there could be a soft landing, but we're looking at sub 2% growth here. What's the one thing that you're watching right now that you think could derail that narrative?
Yeah, as I said earlier, it's really the labor market. The labor market's been a pleasant surprise in the U.S. and elsewhere. The other thing that really surprised in the U.S. labor market last quarter was labor productivity kind of jumped. So unit labor cost, the cost of workers actually fell, which is quite a positive sign for the market. So our view is as long as the labor market strength holds up, this will allow us to decelerate the economy at a measured pace. But if the labor market really starts to go south, and we'll see that in the payroll numbers, if that happens, that means the economy is probably going into a harder landing or a recession, and the Fed would be cutting earlier. But again, that's not our baseline right now, but that's the one key variable to watch in our view.
Paul, let's talk about what's playing out over in Dubai. It's not just world leaders, but business leaders gathered for COP28 to address the climate crisis. One breakthrough, at least on day one there, with the loss and damage fund being established. You've done some interesting research over at S&P, specifically on the impact that physical risk from climate could have on growth globally. I wonder if you can speak to that and whether that assessment, the impact, has changed.
Right. So we just published an article called Lost GDP, and we're trying to get a handle on how much GDP could be at risk if the climate continues to deteriorate and these risks manifest. We came up with a number around 4% of GDP annually by about 2050. In order for that to happen, we'd have to breach the 2 degrees centigrade Celsius mark that everyone's watching very closely. But we'll see. This COP is supposed to be a stock-taking exercise. We're going to measure how closely or not we're following the Paris Agreement. And we've got the technology picture and the financing picture, and as you mentioned, the equity picture. So everyone's going to get together and see if we can make some progress. I think, the last couple of meetings, there's a little bit of convergence around what needs to be done. But, there's still a sense that we're behind. And again, there's the technology piece, the financing piece, and the equity piece. We're going to try to make progress on all three of those.
That hit to GDP, more than 4%, how does that play? I mean, that's global GDP. How do you think that plays out between developed countries and developing countries? Because there's an increasing concern about this huge divide, this divide that continues to grow. The countries that are most affected are the ones that can't pay for the transition.
Well, that's right. The impact of the 4% is quite uneven. Southeast Asia takes a disproportionate hit. Obviously, some of the island economies as well, and the kind of the global north or the advanced countries are kind of low on the list. So again, I think equity is going to be a big issue and a big concern. We know that most of the carbon in the atmosphere was put there by the current industrialized countries, and the current developing countries want to grow and catch up, but they're going to take the biggest hit from climate change. And again, at COP28 and other fora, we're going to have to figure out some sort of mechanism to get the financing and the sort of the protection and cushioning to the most impacted economies. But it's not, we shouldn't have the assumption that all these effects are even or uniform, because that's certainly not the case as far as our research tells us.
Finally, Paul, let's talk about the impact to companies. Certainly a lot of companies represented at Dubai. What we're seeing is interesting. A few years ago, it was about these grand declarations about net zero. A lot of those target dates have been pushed back as these companies assess what's necessary to get to those targets. As you look at the financial risk, the impact to these companies, has that grown along with the climate risk that we have seen when you're talking about what's already played out this year? The hottest year on record.
Yeah, well, let me take your first point first, because, there were a lot of declarations to be net neutral at some future date, 2050, 2060, or whatever, but there really weren't any paths to get there, right? So once you start looking at the path and this transition we need to make, we need to decarbonize the fossil fuel industry and build out the renewables, and what are the costs around all that? So, different sectors, to answer your question, are going to be impacted differently by that. But I think there's kind of a more mature discussion now than there was even a couple of years ago, which is not just the targets, but the path and this transition, and how do we finance that, and the equity issues we talked about before. So as we get a better handle on the climate science, and as we get sort of more clarity around, the path to move away from fossil fuels and decarbonize that and move to renewables, that's going to give a better picture to companies of what their risks are. But I think, in a sense, we're still pretty early in that game, and we're working on that at S&P Global. But that's something where we're going to continue to refine the numbers as the science become clearer and the financing constraints and trade-offs become clearer as well.
Yeah, a lot of this is about data gathering as well. S&P Global Ratings Global Chief Economist Paul Grunwald, good to talk to you today. Appreciate the time.
Thanks very much.
Well, as Paul mentioned, the UN Climate Change Conference, better known as COP28, well underway, with leaders convening to discuss updates from the past year that's taking place in Dubai. One of the most poignant conversations happening there is around the phase out or phase down of fossil fuel use. The International Energy Agency, or the IEA, finding in their most recent World Energy Outlook 2023 that the momentum behind the transition to clean energy, the world is on track to see all fossil fuels peak before 2030. The share of coal, oil, and natural gas in global energy supply has typically been stuck around 80% for the past few decades, and the IEA's findings say it's edging downward to hit about 73% by 2030. But the report also noted that while transitioning may be tough, with geopolitical situations occurring around the world, governments fighting inflation, the pace to develop and scale up investment in new clean energy needs to increase, especially in more emerging and developing economies outside of China. Well, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
A federal judge in Montana has blocked a statewide ban on TikTok from going into effect next year. The move puts a stop to the first attempt in the U.S. for a full ban of the popular app, at least temporarily. Alexis Keenan joins us now with more. Alexis, this is a temporary victory for the app, but how is this likely to move forward?
Yeah, so this federal judge in Montana, he made this decision on this request for injunction, and it favors TikTok users in Montana as well as TikTok, the company itself, over Montana's legislature. And the legislature, what it was going to do was block both downloads and use of TikTok. That law was set to go into effect in the state in January. So the law, though, it was passed in May, and that was after the federal government, as well as 25 or more state governments, banned TikTok on government devices, and that was over national security concerns. And the worry there is that TikTok's owner, ByteDance, could help purportedly spy on Americans because it is subject to a Chinese law and then ultimately the Chinese government. Now, Montana argued that this law protects consumers by super access. What they said is that China's government had this overall overreaching access into all user accounts on TikTok, whether those are Americans or users across the world. TikTok and the users, for their part, they argued that the law, though, was unconstitutional. They said it violated their First Amendment protections to free speech, as well as the Commerce Clause, as well as Foreign Affairs clauses. But it really highlights, this decision does, the difficulty that governments have in facing these and addressing these concerns over user data being protected. Now, the U.S. federal government, it has already been in negotiations with TikTok to try to find a solution for this purported problem. But the status of those negotiations a bit unclear. In March, you go back earlier in this year, you had TikTok's CEO testifying before Congress about these concerns. Before that, you had an executive order by President Trump that failed. It demanded that TikTok take its U.S. entity and divest it to a U.S. company. You also have some legislation that's on the table that would give the Commerce Department the power to ban foreign technology that poses a national security threat. Now, it's important, though, when you're looking at this decision, to step back and see that the judge did leave some room. And in his writing on this decision, he said in the First Amendment analysis, it doesn't stop Montana or any other state, let's say, from trying to protect consumers. He said because the legislature, in writing this law, he said, used an axe to solve its professed concerns when it should have used a constitutional scalpel. So what he's saying there is he wants this to be more fine-tuned in order to even try to withstand this First Amendment scrutiny here. Akiko?
So, Alexis, does this mean that this specific case, at least this ruling, doesn't necessarily set a precedent for all the other efforts to try and ban the app?
So yes and no, because this is an injunction to just stop the law from taking effect. What it still requires is an analysis by the judge to look at the violations that are being alleged and say, would the plaintiffs who are bringing this case, would they succeed on the merits? That means, would they succeed on the underlying case? And this judge's decision is yes, that the plaintiffs would succeed. So it does perhaps set a precedent in terms of analysis, because if you have cases like this brought across the country, other judges could come to the same conclusion. They could come to a different conclusion. But it's also instructive for other plaintiffs who try to bring these cases, and defendants as well, legislatures, to try to craft the legislation differently so that potentially it could withstand this very difficult scrutiny that the First Amendment and some of these other constitutional challenges present.
Okay, certainly not going to be the only effort here to try and get the app banned, as we've seen a lot of pushback. Alexis Keenan, thanks so much for that. Well, Meta is suing the Federal Trade Commission that filed on Thursday. The tech giant arguing the agency has unconstitutional authority over how it enforces cases against companies through its in-house administrative courts. This comes after Meta lost a bid to stop the agency from reopening a 2020 privacy settlement. More on this, let's bring in Yahoo Finance reporter Ali Garfinkel, who's been looking through this particular case. Ali, what does this ultimately mean in terms of what Meta is trying to push through?
Akiko, it's important to be really clear here. Meta is directly challenging the constitutionality of the FTC. Now, but it's important to also be really clear about what specifically that means. Now, the FTC has two key mechanisms through which it addresses antitrust issues. The first is lawsuits, which often make many headlines, and it's something we talk about a lot. And the second is through its administrative process, its in-house courts. Now, this is far from Meta's first run-in with the FTC. The company is, of course, embroiled in an ongoing lawsuit filed by the FTC that dates back to 2020 and involves more than 40 states. And on Monday, the FTC did successfully win a bid to reopen an order accusing Meta of privacy violations against children. Now, what Meta says is pretty fiery. I'll read the statement for you, at least part of it. The FTC's unilateral attempt to rewrite our privacy settlement agreement raises serious and important issues about the FTC's constitutional authority and Meta's due process rights. Monday's ruling did not reach those issues. The FTC shouldn't be the judge, jury, and prosecutor in the same case. Now, it's important to say there are other examples of cases like this in the past where companies have challenged the FTC's authority, challenged its constitutionality, but there aren't that many of them. There is one in process currently being led by a biotech company called Illumina, for example. But ultimately, what I see this as, Akiko, is a shift in tactics for Meta, right? If the allegations aren't working, if it's challenging those allegations isn't working, challenging the process certainly seems like the next step.
Okay, it's going to be interesting to see how this one shakes down. Ali Garfinkel, thanks so much for that. Well, with positive CPI data and dovish Fed speak this week, investors are optimistic that the Fed will hold rates at the meeting later this month. While rates remain high for the foreseeable future, question is, what's the upside? Well, now may be a good time to open a high-yield savings account and benefit from higher than normal interest rates on your money before rates come back down. For more on this, let's bring in Elizabeth Ayola, NerdWallet personal finance writer. Elizabeth, it's good to talk to you today. I will say I personally have been looking through some of these high-yield savings accounts because, it sort of feels like a pretty steady return at a time of so much uncertainty. How much interest have you seen? I mean, how much shifting have you seen in terms of Americans increasingly looking to this as an option to get some return?
Over the past couple of years, we have seen high yield savings account interest rates go up significantly. So back in 2022, rates were below 1%, and now they're above 5%. So I think they're an attractive vehicle for Americans to put money in. It isn't a way to invest, but it is a way to save money and still get interest on your dollars.
So above 5% on some cases, but there is a question about what happens if, in fact, as some expect, the Fed starts to cut maybe later on next year. How do you think our viewers should be looking at the trajectory of those rates?
Well, if the Fed does decide to cut rates anytime next year, that may be a bummer for some people in the sense that they're not going to get as much interest on their money. However, what people should remember is that high yield savings accounts are pretty low risk, in the sense that nothing is going to happen to your principal, nothing's going to happen to the money that you initially save in the account. The only thing that will change is that interest rates that you're getting on your money will potentially go down. However, the upside is that if you have your money sitting idly in a checking account or even in a traditional savings account, your money is not going to accrue as much interest or isn't getting interest at all. And considering the state of inflation, your money actually may be losing value. So all I'm saying is leaving your money in a high yield savings account, even if the Fed does decide to cut rates, is still a better bet than leaving it in a checking account.
Yeah, there is no downside is really the bottom line there. There's so many accounts to go through. And certainly we have seen a lot of these companies kind of step up the outreach, so to speak, to get people to sign up for high yield savings. How do you think viewers should be looking at this? I mean, how do you know what's a better deal versus, if it's just you've got two accounts that are at 5%, how do you think they should be looking at what is the best scenario for that person?
Yeah, so I'm not a financial advisor and I'm not in the position to give advice, but what I can say is that consumers should definitely be looking at any strings that are attached to each of the accounts. So you might go and see a dangling fruit of, let's say, a near 6% high yield savings account, but you should look at things like, how much money do they want you to put in before you can access that amount of interest rate? Also, how good is their customer service? How accessible are ATMs? And are there any hidden fees that come with the account? So these are all things that you also want to look at aside from the interest rate.
Okay, certainly some good takeaways there. Elizabeth Ayola, NerdWallet personal finance writer. Good to talk to you today. Appreciate the time.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, a new food company may be looking to test the public market. Investment group JAB, who owns Panera Bread, Caribou Coffee, and Einstein Brothers Bagels, has reportedly confidentially filed for an IPO. That's according to the Financial Times. Let's bring in our very own Brooke De Palma, who's always on the food beat for us. Brooke, this is, I guess it's a pretty big one. It got a lot of us talking about our thoughts on Panera this morning.
Yeah, lots of us talking about that mac and cheese bowl, perhaps, that bread bowl with some broccoli cheddar soup. But there's also lots of people on the street talking about this. This has been highly anticipated in recent years, as Panera Brands itself has been saying that it's looking for an upcoming IPO. And just to note, Panera Bread was public for 25 years until 2017, when JAB Holdings took it private in a more than $7 billion deal. Now, as you noted, under JAB Holdings, it is now Panera Brands, and that includes Einstein Bros Bagels, Caribou Coffee, and Panera Bread. And in recent years, they've really made changes to the company. Most recently, they named a new CFO, Paul Carbone, in August. He was previously Dunkin' Brands CFO. He also held the CFO position at Yeti as well as Shark Ninja. And they named a new CEO, Jose Alberto Dueñas, back in July. He was Einstein's president and CEO since 2019. They're also building out their board. They promoted Patrick Grismer to lead independent director. He was former CFO of Starbucks. He also was former CFO of Yum Brands, as well as Hyatt Hotels. And Yahoo Finance fan favorite Mike Tattersfield also will be joining as board chairman in January 2024. Of course, he took Krispy Kreme, which also was held by JAB Holdings public back in 2021. It's also slimmed down its workforce by roughly 17% most recently. And if you remember, Kiko, back in July of 2022, Panera Brands did call off its deal with Danny Meyer's special purpose acquisition company due to market conditions. And so this really has been a long time coming, and many people have been keeping a close eye on it.
Yeah, we're hearing about this, Brooke, in a year where we had some pretty high-profile restaurant IPOs. Cava, obviously the big one that you covered as well. What does that tell you about where the appetite is in the market right now for food service, restaurants, listings, IPOs?
Yeah, Kiko. Well, two that we followed really closely this year, Cava and Instacart. Now, both of those companies are down since they made their public debut, but they really rose in their IPO. Their valuations exceeded their pre-IPO targets. And many experts over the past few months, over this course of this year, have been telling me that they were all true tests, and that after roughly 18 months of such a pause in the IPO market, there was a lot of scrutiny on these companies. But as we continue to chat with these executives, most notably when I chatted with Brett Schulman at Yahoo Finance Invest, he continues to emphasize that they are not keeping a close eye on the stock moves day to day, and they really are focused on future growth of the Cava brand, of the company, as they continue to expand. And I think that's a similar narrative that we'll hear from other companies going public in 2024 and from others that did go public this past year.
Okay, we'll keep a close watch on Panera. Brooke DePalma bringing us that story. Thanks so much. Let's do a final check of the markets before we let you go. Rounding out what has been a strong week for all three majors here, coming on the back of a 2023 high yesterday. The Dow now up 187 points, the S&P 500 up 19, and the Nasdaq up 37. This coming as Fed Chair Jay Powell tells the markets, look, things are not done just yet, and that talk of interest rate cuts going into next year is premature. We've been watching the bond yields closely on the back of that as well. All yields on the shorter end as well as the longer end, all down right now. That does it for me in this hour. We've got much more to come here on Yahoo Finance Live. Keep it right here.